cannot set off with any other head. Long-term capital loss can set off only against long-term capital gain. PGBP loss cannot set off against a salary. Owning and maintaining racehorse loss can set off only against the same activity. Non-loss set off against the cash flow income, like lottery, betting, gambling. We cannot set off any losses. Non-loss set off against unexplained income under section 68 and 69. So these are the basic rules of set off. So for final angle, we have to think about the restructuring area. So generally under the income tax law, the loss can be carried forward by the person who created it. Only the creator can carry forward the loss. But in the following 5 cases, even the loss is created by somebody else, another person can carry forward. So number 1, accumulated business loss except speculative loss of an amalgamating company can be carried forward by the amalgamated company. And regarding the business loss, again amalgamated company will get 8 years to carry forward. So total 8 plus 8, 16 years possible. Unabsorbed depreciation, anyway there is no time limit, so infinite period it can carry forward. So except speculative loss, all business losses can be carried. But this rule not applicable for any other head of losses under any other head. And second one, accumulated business loss except speculative loss of demerged company will be available to resulting company, but resulting company will get only the balance period. Similar to amalgamation, they won't get again fresh 8 years. Third one, if a partnership firm is taken by a company or a proprietary concern is taken over by a company, that is not a succession of a firm's business by a company, or proprietary business is taken by a company, the predecessor's loss will be allowed to the successor, and again here the company will get fresh 8 years. And then inheritance. So father or mother is carrying on business, that business is incurred a loss, and the son want to carry over that loss, possible, but the condition is same business of the predecessor should be continued by the successor. So if business changes, then that loss will not be allowed. And here in case of inheritance, only the loss will be allowed for balance period. Now again fresh 8 years, because it is not actually a restructuring, just a continuity of business is there, should be there, and the father's business is continued by son or daughter. So that is the rule of inheritance. There should be some blood relationship. And then last one is conversion of private company or unlisted public company to limited liability partnership. The business losses of private company or unlisted public company will be allowed to the LLP. Again here they will get 8 years. Except amalgamation and demerger, in all other cases, to claim the benefit of predecessor's loss by the successor, the condition of section 47 must be satisfied. So whatever condition mentioned under section 47 equally applicable for loss also. There is no additional condition. But regarding amalgamation and demerger, we have to comply with the definition criteria, and some other conditions prescribed under section 72A should also be satisfied. So what are the conditions of amalgamation? So basically amalgamation defined under section 2 subsection 1B, entity involved must be companies and the shareholders holding at least 75% value of shares of the amalgamating company shall become shareholders in the new company, and all the assets and liabilities of the amalgamating company shall be taken by the amalgamated company. These are the conditions prescribed in definition. In addition to that, additional conditions prescribed under section 72A should be satisfied to carry over predecessor's loss by the amalgamated company. At the time of amalgamation, as on the date of amalgamation, amalgamating company shall satisfy 2 conditions. Number 1, that amalgamating company for which that loss is incurred, that business must be in existence for at least 3 years. So if amalgamating company started a business and just second year they want to amalgamate, then this first year's loss cannot be taken by the amalgamated company. So at least 3 years that business should be in existence. And second condition, see, in order to make some tax evasion, people will do like this. Before making the amalgamation, the substantial assets of the amalgamating company will be sold and amount will be taken by the shareholders. And it will be a shell company, paper company with a huge amount of loss. Then they will make the amalgamation and this loss will be taken by the new company. So this is actually some sort of a evasion method. So to prevent that, they are saying it should be a genuine amalgamation. So majority of the assets held by the amalgamating company at least 2 years prior to the date of amalgamation shall possess as on the date of amalgamation by the amalgamating company. That means substantial assets, they cannot sell it off before amalgamation. So they are saying the condition, hold on the date of amalgamation at least 3 by 4, that is 75% of book value of financial fixed assets held by it at least 2 years prior to the date of amalgamation should be held by the amalgamating company as on the date of amalgamation. So within these 2 years, they can sell only 1 by 4th of their total asset. Majority 3 by 4th of the asset should be present in their hand as on the date of amalgamation. And these two conditions should be satisfied by the amalgamating company as on the date of amalgamation. And next 4 conditions should be satisfied by the amalgamated company after the amalgamation completed. So that is, amalgamated company shall continue such business. Such business means the business for which that loss is taken by the amalgamated company. So that business they must continue for at least for the next 5 years from the date of amalgamation. Plus, what is the total value of assets they taken on the date of amalgamation from the amalgamating company? At least 3 by 4th of that total asset should present in the hands of the amalgamated company for the next 5 years. So that is also a fraud. The very good assets of the amalgamating company will be taken by the amalgamated company, and immediately after amalgamation they will sell it. So they will realize that money, but their loss will be taken and that will be adjusted against profit, and tax is also evaded. So to prevent that, they are saying 3 by 4th of the total value of asset as on the date of amalgamation should be held by the amalgamated company for the next 5 years. Next condition can be relaxed by the central government if it is a manufacturing concern. Achieve 50% of level of total installed production capacity of the amalgamating company as on the date of amalgamation. In terms of actual production, at least 50% of that capacity should be achieved within 4 years in case of actual production. And it must be continued for the 5 year. This 4 year and 5 year both are counting from the date of amalgamation. So accordingly, if within 4 years, if they achieve that 50% level of production, just 1 more year, they have to continue, that's enough. But this condition can be relaxed by the central government upon an application made by this company. And finally, procedure compliance, there is a certificate is required from the chartered accountant to get the benefit of loss set off and carry forward facility. So these are the basic additional conditions prescribed under section 72A. See, these, in addition to this 72A, basic conditions of section 47 should be satisfied. Section 21B amalgamation condition should be satisfied. Definition criteria should satisfy. Actually, section 2 subsection 1B conditions and 47 conditions are more or less same. There is no special conditions under 47. 47 simply says transfer of capital asset by amalgamating company to the amalgamated company in a scheme of amalgamation, not a transfer. That's only mentioning in section 47. So the word amalgamation, if the income tax uses the word amalgamation, that word definition should be taken from section 21B. This meaning should be assigned. So all other amalgamations are not amalgamation under tax law. So won't get the benefit of capital gain exemption under 47 and won't get the benefit of carry forward of section 72A. So this is very strict. Section 21B amalgamation condition should be satisfied. So sometimes some of the amalgamation happened practically may not satisfy these conditions. In those scenario, they won't get the benefit of capital gain exemption. They have to pay capital gain tax, and they won't get the benefit of loss carry forward. So this is amalgamation. So now we can go to the question straight away. So take the question. Question number 21. ABC Limited was amalgamated with XYZ Limited on 1st April 2024 as on the beginning of our previous year. Suppose if the amalgamation is carried out in between during the previous year, for example, middle of the previous year, not on 1st April, not on 31st March, in between, there is another problem. In that year, we have to compute the depreciation, full depreciation we have to compute. And that depreciation should be allocated towards the old company and the new company based on number of days asset used by both of them. So out of 365 days, how many days asset used by amalgamating company and remaining days used by amalgamated company. So in that days ratio, depreciation has to be bifurcated. That is provided under section 32. If beginning of the year amalgamation is happening for the current year 24-25, and that depreciation will be available to new company, amalgamated company. If amalgamation happened as on the next year beginning, then for the current year, depreciation can be claimed to be old company, and from next year onwards, new company can claim. But during the previous year, in between, during the previous year, if amalgamation happens, depreciation should be allocated towards the predecessor and successor based on number of days asset used by both of them. So here all the conditions of 2(1) satisfied. Amalgamation on 1st April 24, beginning of the year. ABC Limited has the following carry forward losses. ABC Limited is the old company, remember. New company, XYZ Limited. This is amalgamating company. Old company details is given. Speculative loss 4 lakhs. Unabsorbed depreciation 18 lakhs. Unabsorbed expenditure of capital nature on scientific research. That means under section 35, we can claim in-house research capital expenditure on scientific research. But before claiming section 35 capital expenditure on scientific research, we claimed all other expenses. So profit was, for example, 5 lakhs. We claimed all other expense including depreciation, but we didn't claim the 35 scientific research capital expense. Profit is 5 lakh, but capital expense on scientific research is 10 lakhs. Out of 5 lakh, we cannot reduce 10. In that situation, there will be -5. We should not take it as business loss. It should be called as unabsorbed capital expenditure on scientific research. It should be treated like unabsorbed depreciation. Infinite period you can carry forward. Even though return is filed belated, you can carry forward. You can set off with any head of income, because unabsorbed depreciation can be set off against any head of income except salary and except casual income and except black money. So with any other head you can set off. So similarly, unabsorbed capital expenditure on scientific research you can set off. There is one more item. Under section 36, family planning capital expenditure incurred amongst the employees, a company can claim in 5 equal installments. So that 1/5th installment you are claiming, but due to inadequacy of profit, entire amount of that deduction could not be claimed off. That deficiencies also will be called as unabsorbed capital expenditure on family planning. That is also similar to unabsorbed depreciation. So we can say unabsorbed depreciation family has total 3 members. Unabsorbed depreciation, purely the depreciation which cannot be claimed due to inadequacy of profit or non-availability of profit. Section 32 subsection 2, unabsorbed depreciation. Number 2, unabsorbed capital expenditure on scientific research, which is prescribed in section 35 subsection 4. And third, unabsorbed capital expenditure on family planning mentioned in section 36. So these 3 together, we will call it as unabsorbed depreciation. Infinite period carry forward. Even though return is not filed on due date, belated return you can carry forward. In case of business restructuring, predecessors, these 3 items can be claimed by the successor. Now, business loss of the old company 120. So these details are given, that is belongs to the old company. Amalgamation happened on 1st April. Now they are giving the details of the new company. XYZ Limited, that's a new company, has computed a profit of rupees 140 lakhs for the financial year 24-25 before setting off the eligible losses of ABC Limited. But after providing depreciation, so before setting off the above losses, but they claimed depreciation after depreciation. But the depreciation they computed at 15% per annum on rupees 150 lakhs being the consideration at which plant and machinery were transferred to XYZ Limited. The return on value as per Income Tax Act record of ABC Limited as on 1st April 2024 was rupees 100 lakhs. So they made a mistake. As per the provisions of section 43, that is special cases of actual cost, section 43 says, if capital asset, that is a depreciable asset received under amalgamation, actual cost of the amalgamated company shall be WDV of the amalgamating company. So all the companies WDV as per income tax is only the actual cost of the new company. Any revalued figure or intrinsic figure that will never be permitted under the tax law, especially under depreciation, that will never be permitted. So all the companies WDV as on 1/4/2024 is 100 lakhs, but they take it as 150. So on 150 they provide a depreciation 15%. So that is wrong. They have to take the WDV 100 lakhs. So their depreciation is overstated. They claimed depreciation excess. So their excess depreciation should be add back. So we have to correct the profit of the new company, XYZ Limited. That is 140 lakhs is the profit after depreciation providing at 15% per annum. But they can claim only 15% on 100 lakhs. They claimed in 150 lakhs. So excess depreciation, 50 lakhs into 15%. 50 lakhs into 15% will be 50 lakhs into 15%. 50 lakhs into 15%, how much? 7.5 lakhs. That 7.5 lakhs is the excess depreciation that should be add back, so that the profit of the new company will be correct. So 140 is wrong, 147.5. So first we have to correct the profit. And then The next point, the above profit of XYZ Limited includes speculative profit of 10 lakhs. Okay, out of this profit of 147.5, after correcting the mistaken depreciation, the correct profit is 147.5. This 147.5 includes speculative profit of 10 lakhs. So that has not a relevant point here. Now we can apply the amalgamation point. So first we should make the calculation of depreciation correction, right? So XYZ Limited, net profit 140 lakhs. So add excess depreciation 150 minus 100 into 15%, 7.5. So 147.5 recalculated correct profit before set off of losses. Now we can apply the provisions of section 72A. Less section 72A, predecessor's loss, ABC Limited's loss will be available to XYZ Limited. So what are the losses eligible? Speculative loss, not at all eligible, that we cannot take, because section 72A clearly says business loss of the predecessor except speculative loss. Then they are saying unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on family planning, and brought forward business loss can be claimed by the new company. So this is eligible, this is eligible, this is eligible. Speculative loss is not eligible. So when we are making the loss set off, there is an order of set off that is prescribed under section 72 subsection 2, which says that when you are making the set off, first you must give preference to current year depreciation, and then brought forward business loss, and only last unabsorbed depreciation. Here there is no current year depreciation. Okay, so we can consider the brought forward business loss or the predecessor's business loss, that is this 120. So less business loss of ABC Limited available to XYZ Limited under a scheme of amalgamation 120. Balance 27.5 lakhs. Yes. Now there is unabsorbed depreciation and unabsorbed capital expenditure on scientific research. Both are same effect, so you can take together. No issue. There is no in between. There is no order. Both are same. So 18 plus 2, 20. So brought forward unabsorbed depreciation under section 32 subsection 2 and unabsorbed capital expenditure on scientific research, total 20 lakhs. So the profit will be, total income of the new company will be 7.5 lakhs. Compute total income of XYZ Limited and indicate the losses or other elements to be carried forward by it. Actually, there is nothing left to carry forward because the entire losses of the predecessor can be set off with the profit of the new company. So the total income will be 7.5 lakhs. No, this speculative loss belongs to which company? Predecessor. Predecessor. As per section 72A, only business loss except speculative loss and unabsorbed depreciation of predecessor only can be taken. XYZ is the new company which have a speculative profit, but we cannot take that speculative loss because that speculative loss belongs to predecessor, right? Yeah, that's clearly they're saying the above profit of XYZ Limited includes speculative profit of 10 lakhs. Why you are reducing it? You cannot set off speculative loss here. Okay, that you ignored. Fine, you got okay. Speculative loss, you ignored it. Okay, then what's your point? Yeah, of the new company. Yeah.
In 140 include 10 lakh.
Yeah.
In 10 lakh, he not able to set up any losses.
So first of all, remember all the set of losses, the rules are applicable only for losses. Regarding speculative profit, against the speculative profit, you can set off any loss. So when you study the speculative loss chapter, always keep in mind, restriction is always for losses, not for income. Even 35 AD loss, you can set off only against the 35 income, right? If you have 35 income, other business loss you can set off. You see, restriction for income arises only in case of two cases. Lottery, betting, gambling, card game, casual income. Against that income, you cannot set off any loss. Black money, unexplained income 68 and 69. You cannot set off any. All other cases, restriction is only for loss. So further there is no relevance. So there is no need to bifurcate, right? It should be there. And further points are speculative loss. Then we should be careful because it can carry forward only for 4 years. Speculative loss cannot set off with any other income. Here it is speculative income, so no problem. Got it? So any other doubts? This is amalgamation, typical question, right? Don't expect this type of problem because recently the questions, level of question is a little bit tough. They won't ask this type of a question. Probably they will ask a question starting with a new company, a full detailed P&L account will be given, assessment of a company. In last paragraph, they will say this company got amalgamated within the current year with there is another company, old company they taken over. The details of the losses of the old company will be given like this. Okay. Independent question like this, there is no chance. Actually, it's an exam question, old question. Demerger. Demerger, when it is compared to loss concept, not that much attractive because only remaining period the new company will able to, resulting company will able to carry over that loss. No fresh 8 years is allowed. But 47 capital gain obviously not taxable. 47. So as per section 2 subsection 19 AA to accept it as a demerger, first primary condition entity involved should be companies. Companies Act provision should be satisfied. One of the undertaking must be transferred. That undertaking completely to be transferred under demerger. All the assets and liabilities of that division, that particular unit, that particular undertaking should be transferred. That liabilities and properties of that undertaking should be transferred to the new company at its book value, and the resulting company must account that assets and liabilities in its new books of accounts as its book value, at its book value. But the problem is, if the new resulting company is following Ind AS, then they have to mandatorily convert that into fair value. So they have to account it in fair value. Okay, in that case, that is an exception. If resulting company following Ind AS, then they can revalue the assets and liabilities and they can show that fair value. But in all other cases, whatever assets and liabilities of the demerged company's undertaking is taken by the resulting company, that should be accounted at its book value in the new company's books. Other conditions same, that is persons holding 75% shares in the demerged company shall become shareholders in the resulting company. So what happened is, demerged company shareholders, they will have 2 shares. Already they have demerged company shares, that will be there because demerged company is still existing. Only part of the company is splitted and a new company is created. Plus they will get additional shares from the resulting company. So they will have 2 sets of shares, old company shares with less value and new company shares. Because in amalgamation, old company is no more. But in demerger, old company is there. One of the division is splitted and a new company is created. If these conditions satisfied, the business loss and unabsorbed depreciation, except a speculative loss of that particular undertaking of the demerged company, can be taken to the resulting company. See, demerged company is a big company having 2 divisions, division A and division B. If demerged company has a loss of 10 lakhs, but there is no bifurcation whether this 10 lakhs loss is attributable to division A or division B. Division B is subject to demerger, resulting company created. This loss is for the associate as a whole, demerged company as a whole. Then how we will allocate this loss to the new company? So how we can say this loss is attributable to this particular division which is subject to demerger? Or whether it is allowed to the old other department which is continued with the demerged company, or whether it is common for these 2 departments together, then what we will do? So if it is able to differentiate that, if these business loss and unabsorbed depreciation exclusively related to that particular undertaking which is subject to demerger now, then that entire business loss and unabsorbed depreciation can be taken by the resulting company. If there is no any specific allocation towards the existing or the new entity which is subject to demerger, in that situation the only way is we have to use the asset ratio to allocate, because this loss and unabsorbed depreciation common to the undertaking. There are 2 divisions, so we have to allocate this only to that particular undertaking which is subject to demerger. For that we have to use the asset ratio. Book value of total assets before demerger, out of which how much book value of asset is transferred to resulting company, in that ratio the common business loss and unabsorbed depreciation must be splitted, and only those portion will be allowed to the resulting company. Remaining can be carried forward by demerged company. But if the entire business loss and unabsorbed depreciation of the demerged company is attributable to this new company, that is a resulting company's division, then entire loss can be taken by the resulting company. There is no other additional condition just as that of amalgamation, because the reason is simple. Amalgamated company will get again fresh 8 years, but resulting company won't get again 8 years. So there is no need for putting additional condition. That is why no additional condition. Only this basic condition satisfied, they can carry forward. This is demerger. Now, the other points that we already discussed earlier, that is in case of conversion of company into LLP, and partnership firm is taken by company, and succession of proprietary business by a company. All those conditions we earlier discussed, that is same as that under section 47. Only difference is in case of conversion of company into LLP, there are certain additional conditions. The accumulated profit of the company, if it is taken over by the LLP under conversion, that should not be distributed among the partners within a period of 3 years. And further, the book value of the asset of the company before the conversion should not exceed 5 crore in any of the last 3 years. So if these are the additional conditions in case of conversion of company into LLP, all other conditions more or less same. So in case of conversion of company into LLP, that is another succession. Proprietary is taken by company and firm is taken by company. In these 3 cases, remember, normal rule, predecessors, business loss and unabsorbed depreciation except speculative loss allowed to the successor. They will get again fresh 8 years. And capital gain does not taxable, 47. Capital assets not will not be treated as transfer. And further, to compute the depreciation of the new company, WDV of all the depreciable asset of the predecessor shall become actual cost of the new company. If company converted into LLP, there is a possibility that company will have unadjusted MAT credit. That unutilized MAT credit they may have. As per section 115 JAA, they may have a MAT credit. So whether that unutilized MAT credit of the predecessor company allowed to the LLP, that is a question. The answer is absolutely not, because for LLP the concept is AMD. There is no MAT. So MAT and AMD literally feels like same, but actually both are completely different context. MAT is computed on book profit. AMD is computed on adjusted total income. And MAT rate is different, AMD rate is different. MAT computation is purely based on profit and loss account prepared as per books of accounts. But the other one is based on adjusted total income as per the normal provisions of the IT Act, increased with certain incentives. We are arriving at adjusted total income and computing AMD. So both are completely different computations. So MAT credit and AMD credit you cannot compare. So that is why if it is an LLP, conversion of company into LLP, if there is unutilized MAT credit with the company, that will not be available to the LLP. That is not possible. Similarly, if a private company is taken over by a company, a proprietary is taken over by a company, or partnership firm is taken over by a company, succession of proprietary business by a company and firm's business by a company, proprietor or the partnership firm would have been paid AMD. So there may be an AMD credit in the hands of firm or proprietor, and it is taken by a company. That AMD credit cannot be taken by the company also. So AMD credit and MAT credit is not interchangeable. Both are completely different. And if any capital asset of the proprietor or capital asset of the partnership firm taken by company, and subsequently company is transferring that, to determine long term and short term, the period of holding of the proprietor and partnership firm should also be counted to the period of holding by company. Similarly, we can apply Manjula J. Shah's case also. Yeah, these are the main points you have to keep in mind regarding this one. And another issue, 35 AD asset. If the predecessor claimed 35 AD reduction for an asset under section 35 AD, and that asset is available in the balance sheet, this asset is given to the new company under amalgamation or maybe demerger, or in case of succession, or in case of conversion. That situation, remember, it is a 35 AD asset. Predecessor already claimed complete cost of that asset as reduction to 35 AD. So its cost must be taken as zero, nil to the new company or to the successor. Its cost must be taken as nil. So these are the point related to this amalgamation and demerger, these things. Section 32, depreciation. If the amalgamation or demerger or these type of restructuring happened during the previous year, depreciation should be allocated and both persons can claim depreciation. As per section 43, WDV of the predecessor actual cost of the successor. As per section 72A, loss can be carried forward. As per section 47, capital gain not taxable. Now, unutilized MAT credit not available. As per section 49, predecessor's original cost of capital asset can be claimed as cost of acquisition of the successor. So these are the overall points connected to restructuring. Now we can go to question number 22. Harish Jairaj Private Limited is converted into Harish Jairaj LLP on 1st January 2025. So the restructuring has happened during the previous year. So the problem is depreciation has to be allocated. The following particulars are available to you. This is a conversion of company into LLP, private company into LLP. WDV of land as on 1/4/2024 belongs to the private limited company 5 lakhs. WDV of land, that data itself is wrong. Land has no WDV, so we have to take it as original cost. WDV of machinery as on 1/4/2024, that is private limited company's opening WDV 3,30,000. Patent acquired in 1st June 2024. Remember, it is an intangible asset, depreciable asset. Building acquired on 12th March 2024, for which deduction was allowed under section 35 AD. 12 March 2024 means last year. For entire deduction is claimed by the company. So its actual cost to the new company will be nil. To the LLP will be nil. Above building was revalued, that's not relevant. Unabsorbed business loss as on 1/4/2024. Unabsorbed business loss as on 1/4/2024 means it belongs to the old assessee, that is belongs to the company, private company, 9 lakhs. It's business loss. Though the conversion into LLP took place on 1st January 2025, there was disruption of business and assets were put into use by the LLP only from 1st March 2025 onwards. The company earned profit of rupees 8 lakh prior to computation of depreciation. What they are asking, assuming that the necessary conditions laid down in section 47(13)(b) of the Income Tax Act has been complied with, explain the tax treatment of the above in the hands of the LLP. So the problem is they have given the profit of the company prior to computation of depreciation, and prior to conversion the profit of the company is given. So we have to compute the total income of the company first. So after computing the total income, then only we can arrive whether there is any loss for the old company. If there is any loss, that loss will be available to the LLP. So we are going to compute the taxable income of the company, that is private limited, Jairaj Private Limited. Harish Jairaj Private Limited. Profit given before section 32, that is, what is the profit? Yeah, that is 8 lakhs. Less depreciation under section 32. Not easy, because the restructuring happened during the previous year. So depreciation can be claimed by both of them, predecessor and successor. Here the depreciable asset, 2 assets are there. One is machinery, 3,30,000 open in WDV, and patent 1/6/2024 3 lakh. Land is not a depreciable asset, 35D asset, no depreciation. So only 2 assets are there. So I'm going to compute the depreciation. The restructuring is happened on 1/1/2025. Our previous year starting from 1/4/2024 and ending on 31st March 2025. So prior to this company, after this LLP. Now there is another issue. There was a disruption of business. When there is a disruption of business, So business started only from 1st March. So even though restructuring happened on 1st January, business started only from 1st March by the LLP. 1st March 25. So in between this period, no use, not used, the assets are not used. So there are two assets. First we can take plant and machinery. Open in WDF machinery 3,30,000. Into 15% depreciation. As plant and machinery, normal rate 15%. So 3,30,000 in 15%, how much? What? 49,500, right? So this 49,500 depreciation should be allocated towards the company and LLP based on number of days it is used by both of them. So here, total number of days in the previous year is 365 days minus the asset has not been used for January 31st, February 28. So balance number of days. 306. So 49,500 divided by 306 days into asset used by the predecessor. That is, here the predecessor is company. Company used up to 31st December 24 from 1st April, because from 1st January onwards converted. So April 30, May 31, June 30, July 31, August 31, September 30, October 31, November 30, December 31. What's the total? 275. What is the amount? 47,000, 37, 295. This 37,295 depreciation can be claimed by the company in respect of plant and machinery. The amount is not this correct. 40, 44, 485. Okay, fine. 48, 485. Yeah. Now patents. Yeah, patent occurred on 1st June 2024. Patents. 3 lakh. The depreciation rate for patent is 25% intangible asset. This put use for more than 180 days. So 3 lakh into 25%, how much? 75,000, right? This 75,000 should also be splitted among the company and LLP. So 75,000 depreciation on patent divided by. See, it is acquired on 1st June 2024 only. So we cannot take 365 days. From here to 31st December, then plus 1st March to 31st March. What is the total number of days? So June 30, July 31, August 31, September 30, October 31, November 30, December 31, January didn't put use, February didn't put use, March 31. 245 into from 1st June till 31st December. What is the date? June 30, July 31, August 31, September 30, October 31, November 30, December 31. 214. That is available to company. How much? 65, 510. 65, 510. So remaining will be available to the LLP. 65, 510. What is the balance? 9490. In the plant and machinery, what is the balance? 50, 5015. It's available to the new LLP. Now we claimed depreciation. So current year PGBP of Harish Private Limited before set off of losses. What is the amount? 7 lakhs? No, 6 lakh? 90,000? 5. Correct? Less. This old company has a loss, unabsorbed business loss related to 1920. So 1920 means 8 years has not been expired. It's an eligible loss, 9 lakhs. So the profit available is only 6,90,005, but the loss is 9 lakhs. So we cannot claim entire. So there will be an unabsorbed. How much? Four lakh, 2 lakh, 9,995. So we computed the taxable income of the company, that is 2,09,995 is the ultimate loss. This loss can be carried over by the LLP, and this can be taken by LLP for the next 8 assessment years. So company's computation is over. So ultimately company incurred a loss. So this loss can be carried forward by the new LLP for the next 8 years. And here further points, depreciation available to the new LLP will be 5,015 out of plant and machinery, 9,490 out of patent, and they can carry over the land. The original cost of this land to the new LLP will be 5 lakh. And after claiming this depreciation, what is a closing WDV of machinery that can be taken as actual cost of the new company? Patent minus total depreciation can be claimed as actual cost of the new LLP. For 35 AD asset, nil. We have to put a note. 35 AD entire deduction can be claimed by the predecessor. So its actual cost must be taken as nil. Business loss available to the new LLP is only 2,09,995. So usually they will give the ultimate loss of the predecessor after setting off. But in this question, we have to compute the depreciation, we have to compute the total income, and arrive what is the eligible losses available with the old company. That should be taken by the LLP. There you have to put a note. So this 2,09,995 as per section 72A can be taken by LLP, and all others are further adjustments. We have to put separate notes. Depreciation available to LLP, how much? What is actual cost of the land to the new assessee? And what is the WDV of the new asset? That is actual cost of this plant and machinery and patent to the new LLP will be after reducing this depreciation. What is the WDV? That should be the actual cost of the new entity. Yeah. Yeah. No, that is only in accounts, right? Under the tax law, if you put the asset for more than 180 days, you will get full. If the asset is put for less than 180 days, half. There is no other concept. Under the income tax law, depreciation is a fixed allowance. That is why you can carry for infinite period. That is why depreciation cannot be disallowed. That is why they put the provision 40A 1A not applicable for depreciation. So they created provision 43. If asset is purchased more than 10,000 in a single day, you made payment in cash. Actual cost is not allowed. They can't disallow depreciation, right? By applying 40A3. Or TDS is not deducted. They cannot disallow depreciation, right? Income tax law depreciation available only at the year end, only if asset is remains in your hand, full or half. That's it. Got it. Only for allocation purpose they are saying use the days. Asset used by both of them. Now, the other important provision regarding losses at the final level we have to discuss is 79 and 78. Section 78 is a special provision which contains two subsections, 78 subsection 1 and 78 subsection 2. Yeah. Machinery and patent will be transferred to LLP. Yeah. See, In that question, I will explain. They're saying explain the tax treatment of the above in the hands of LLP, right? So if you want to write down the WDV or actual cost of the new LLP for these assets, there are two possible options. Number one, if you are saying that what is the WDV as on 1/4/2025 to the LLP, then both that depreciation should be reduced from the cost. Balance will be the closing WDV available as actual cost to the new company, sorry, new LLP. But if you are writing the event happens on 1/1/2025, right? So if you are writing the WDV as on or actual cost of the new LLP as on 1/1/2025, then remember only the depreciation claimed by the company should be reduced from the opening WDV. The remaining should be taken as the actual cost. Both way you can write. So if you are saying that what will be the WDV of these assets in the hands of the LLP depends upon date. If it is as on 1/4/2025, both the depreciation, that is depreciation claimed by company and LLP, should be reduced from machinery's opening WDV and patent. Balance is the closing WDV that will be available as opening WDV of the LLP. But if we are specifically saying that what is the WDV as on 1/1/25, that is a date on which LLP is created. In that case, we have to reduce only the depreciation claimed by old company, because next depreciation they are going to claim. Which date we are taken, we can write like that. '78 contains two parts, 78(1) and 78(2). 78 subsection 1 is very, very important. 78 subsection 2 only theory purpose and some case laws. 78(1) is the core area because it's directly connected to assessment of firm and LLP. See, the general concept of loss under the income tax law or the principle of the tax law, if you read the law carefully, that is, the loss can be carried forward by the person who created it. There are certain exceptions is provided, that is obviously amalgamation, demerger, conversion, succession, inheritance. Even though loss is incurred by the predecessor, successor can carry over. So except those situations, in all other cases, loss can be carried forward by the person who created it. So a partnership firm under the income tax law, firm is separate person, partners are separate person. In India, it is treated as two different persons. But in a lot of foreign countries, it's not like that. It is treated as a fiscally transparent entity in a lot of foreign countries. But in India, firm is a separate person, partner is a separate person. See, partners together is known as firm. So if a firm created losses, all those partners are responsible. So firm created a loss. And now the firm want to carry forward that loss to the next year. But immediately, one partner is going out of the firm, either by way of retirement or by way of death. Going out of the firm, that's very clearly saying. Reconstitution or change in constitution of the deed due to a partner is going out of the firm. That is practically only two, either retirement or death. In that situation, law says that, see, that loss is incurred by you four partners, but now one partner is going out and remaining three you want to carry forward. Then do one thing, outgoing partner share in the losses of the firm should be eliminated. That is not permitted to carry forward by the firm. This is section 78 subsection 1. So whenever a partner is going out of the firm, outgoing partners share in the losses of the firm. Sir, losses means all losses. HP loss, PGBP loss, capital loss, all losses except unabsorbed depreciation, because that is due to non-availability of profit, we cannot claim depreciation. It is again, it's a fixed allowance. So that is not as unabsorbed depreciation. Always unabsorbed depreciation has a special privilege. So other than unabsorbed depreciation, any other business loss is there at the time of a partner is exiting, then the exit partner's share in the losses should be eliminated from the total loss of the firm, and only the remaining losses will be permitted to carry forward by the firm. So this is the provision 78 subsection, very dangerous. Sir, what about that portion of losses eliminated? Can it be carried forward by the partner as his individual loss? No, that is not possible. At that time, Income Tax Act will say the loss is created by the firm. You cannot carry forward. It's very interesting. Now 78 subsection 2. 78 subsection 2 says that in case of inheritance, even though the loss is created by the predecessor, the successor can carry forward that loss. So this is prescribed in 78 subsection 2. But all other cases are prescribed in 72A, amalgamation, demerger, etc. 72A. But this one is only in 78.2. So normally inheritance means there should be some sort of a blood relationship should be there, and pure family members should continue the business, and same business must be continued. Same business must be continued. Then only that losses will be permitted to carry forward by the successor. So upon death of the father, son can carry forward the business losses of the father created by the father, provided same business of father should be continued by son. There is a important case is there, old case is there, that is Pramod Mittal, that is a recent case, actually Saroj Agarwal and Madhukant Mehta. So father carried on business and he stopped the business or he died. That firm business has a lot of losses. That business was a proprietary business. But father has two children. So both of them want to continue the business of the father. But as they are two, they cannot carry on any proprietary business. So they created a partnership firm. And these two children of the associate, that's STL, predecessor, becomes the partners in the firm. Now outsiders are partners. And they want to carry over the business of the father and also the losses created by the father. But assessing officer objected, stating that the loss is created by the predecessor, which is a proprietary concern, but now you are a partnership concern. So constitution changed, so this won't be permitted. But they are saying no, we both the partners are actually children of the same predecessor. So now outsiders are partners. We are continuing the same business, but we are created partnership because we brothers and sister, right? Or we have two brothers, right? If one person, definitely we will continue as a sole proprietor, but we are two, right? That's why. Department didn't allow it and they went to court. So court says no problem. It is a clear case of inheritance, right? Change in constitution, not a problem. The only condition act says same business must be continued. So if there is any outside person as a partner into that firm, then okay, the things will be different. Otherwise, no problem. So legal heirs of deceased proprietor enters into partnership and carries the same business in the same trade name. It is a succession by inheritance. The loss can carry forward by the reconstituted firm. No problem. That is Madhukant Mehta, 2002 Supreme Court. Next one is a little bit different scenario. It's a combination of 78.1 and 78.2. And this case, there is a partnership firm. As per the provisions of the partnership deed, upon death of a partner, the immediate relative of that deceased partner will be immediately inducted as partner. And the same business will be continued. No change in profit sharing ratio, no change in capital contribution, nothing. The same position will continue. So if a partner died, immediate legal representative of that partner will be inducted as partner. So this is the provision contained in the deed. So one partner died. His legal heir is put into as partnership as a partner. And the firm continued. At that time, the firm incurred a loss. So AO is saying that no, I will apply section 78 subsection 1. One of the partner is died. So his share from the total loss of the firm must be reduced, and remaining loss only will be allowed to set off or carry forward by the firm. They went to Supreme Court. So Supreme Court says no problem. As the legal representative of the deceased partner, that is the direct relative, blood relative, is immediately inducted as partner into the firm, it can be treated like a case of inheritance. So no problem. There is no change in constitution. The entire loss can be carried forward by the firm. No need to apply 78 subsection 1. That is Saroj Agarwal, Supreme Court. These two are old cases but landmark decisions. Now there is a recent case, Pramod Mittal. A partnership firm was dissolved. Total 3 partners. Complete partners has been settled. So 2 partners, they doesn't want to continue the business. But one of the partner, he is saying, I want to continue this old business. Other partner saying, no problem, we have no objection. If you want to continue, you can continue. So after dissolution, one of the partners started a new proprietorship concern and he put the same name of the firm and same business he is continuing. And he tried to carry over the losses created by that partnership firm. At the time of dissolution, firm has a lot of losses. That loss is taken by this partner. And he is saying it is a case of inheritance. So High Court says, no, it is not a case of inheritance. The firm is completely dissolved. So you are starting a new business just like that. Maybe you were a partner in that firm, but now you are a proprietor. it's a new business. Even though you continue the same business, there is no provision under the tax law to carry over the loss of a dissolved firm by the any other partners. That is not possible. So it is not allowed. It is not the case of Saroj Agarwal. It is not the case of Madhukanta Mehta. It is not a case of 78, subsection 2, not allowed. So that is Pramod Mittal. The loss suffered by an erstwhile firm which was dissolved cannot be carried forward for set off by the individual partner who took over the business of the firm as a sole proprietor as a succession by inheritance. That is not possible. So this is section 78, subsection 1 and 2. The 78.1, they may ask some adjustments and a question based on assessment of firm and LLP. 72, general theory question they may ask, or some case laws they can ask. Now 79. So it is a restriction applicable for a closely held company, or we can say private company, or we can say a company in which public are not substantially interested. So closely held company, or other name, company in which public are not substantially interested, or we can say private company. So in case of a private company, shareholders holding at least 51% shares of the company should be the same in the following 2 dates. Otherwise, the loss of that company cannot set off or cannot carry forward. It will lose forever. So, the shareholders holding at least 51% share capital, or the persons holding at least 51% share capital of the company as on the last day of the previous year in which company incurred a loss, they must be the same persons, or they shall be there as on the last day of the previous year in which this company want to set off or carry forward this particular loss. So if there is a substantial change in shareholding pattern, the loss of the private company cannot carry forward or cannot set off. It's a very dangerous provision. So persons holding 51% equity shares of the company on the following 2 dates must be the same. Otherwise, loss cannot set off or carry forward. Number 1, last day of the previous year in which loss is incurred, and last day of the previous year in which such a loss is going to set off and carry forward. In these 2 dates, persons holding at least 51% or the major shareholders should be same. If this condition violated, then such a loss cannot set off and cannot carry forward. So this is the provision under section 79. But there are a lot of exceptions is prescribed. There are certain exceptions. In case of unabsorbed depreciation and also unabsorbed capital expenditure on scientific research and unabsorbed capital expense on family planning, this rule is not applicable. Even though there is a change in shareholding pattern, you can carry forward and set off, no problem. Second one, eligible startup under section 80 IAC. As per section 80 IAC, eligible startup can claim deduction for their profit. So a lot of other conditions prescribed in 80 IAC. So if it is an eligible startup, they can set off and carry forward the losses, provided the condition is, see, sometimes when the startup is starting, initial years, it will create a lot of losses. So in order to continue the startup, they need more funds, more investment. So when they are asking for a fund to the outsiders, they will put a condition. Okay, we will give you the fund, but on condition. In future, sometimes your company may be big. At that time, we won't get the benefit. So do one thing. If you allot shares to us, we will invest money in your business. So definitely they will allot some shares to the investor. So automatically their shareholding pattern will change. Earlier, these 2 startup promoters, only they are holding 100% shares. But now they may have only 40%, 60% will be held by the investors. So shareholding pattern changed. Initially, yes, there is a loss. So this loss they cannot set off and carry forward. To relax this provision, they are saying, okay, no problem. If that loss is incurred within the first 7 years, for a period of 10 years, this loss is incurred for the first 10 years. And the second condition, all the shareholders as on the last day of the previous year in which loss is incurred, they must become shareholders in that startup. They should be there. That promoter should be there, but they need not have 51% share. So that's a second relaxation. Eligible startup under section 80 IAC. If all the shareholders holding equity shares as on the last day of the previous year in which loss incurred shall continue to hold those shares. Earlier, if they hold 100 shares, they must hold 100 shares. Now maybe share capital may be altered, authorized share capital is increased, more shares may be issued, but whatever shares they held at the time of loss incurred by the company, they should hold it. They should not exit. With that existing shares, they should be there. Maybe more additional shares, their shareholding pattern may be compared to the percentage may be less than 51%, no problem. But they should be there with that original shares. plus such a loss has been incurred during the period of 10 years, beginning from the year in which such a company is incorporated. Because it's a startup, right? Definitely initial years there will be loss. So they need more investors. So that is why this relaxation is given. Now third one, a shareholder is died. So due to which shareholding pattern changed. One of the shareholder is holding 63%, he died. So because of that, shares has been transferred to some other person, no problem. Due to that shareholding change in that shareholding due to death of a shareholder, this provision not applicable, loss can carry forward and set off. And or the original shareholder gifted that share to his relative. So here the relative means the general meaning as per the income tax law, spouse of the individual, brothers or sisters of the individual, lineal ascendant, lineal descendant. That is a normal definition of relative under income tax law. So under the tax law, relative has different meaning in different context. But here it is general meaning. So spouse, brothers or sisters, lineal ascendant, descendant. If they gifted to relative, due to that change happened, no problem. And then the next exception is anyway, the company is loss making company and finally they want to make it an application to Insolvency and Bankruptcy Code IBC and their application is accepted and then resolution plan is approved by IBC code, then it's okay, no problem. Because definitely a lot of new investors will come and take over this company, they will try to revive that company. So no problem, that loss will be available to the new persons. At least they can avoid the payment of income tax in the initial years by using this loss set off. So that is why, okay, no problem. Next one, similar to this, sometimes a company's board of directors may be suspended by the government, by the central government as per the court orders or something like that in exceptional cases as per section 241, and new directors has been appointed for such a company and subsidiary of such a company and the subsidiary of such a subsidiary. So 3 level, holding, subsidiary. So if holding company, its board of directors has been suspended by company central government under section 241 and new directors appointed. So for this company and the subsidiary, all these 3 company, section 79 not applicable due to change, because it's a subsidiary. Definitely if the shareholding pattern here changes, here also change, no problem, they can carry forward. Another condition is there is a strategic disinvestment of public sector company. As we are aware, a lot of public sector companies are there. The central government is want to sell it to private sector, like we can say Air India, taken by Tata. So a lot of similar type of mergers are happening. So in those situations, the original shareholder is actually central government at the time of loss incurring, but now it is Tata. But they are putting a condition, okay, Tata should be there for the next remaining period. So Tata shareholding should not be below 51%. Then it is no problem. Government directly hand over to Tata. So at the time of loss incurring, government was the shareholder, but now it is Tata at the time of set off. But no problem, Tata can set off, but Tata should hold at least 51%. Change in shareholding due to strategic disinvestment, the ultimate holding company of such a public sector company shall hold the 51% equity shares. So these are the exceptions to section 79. Even though shareholding pattern coming below 51%, no problem, loss can set off. Anyway, these provisions are not applicable for unabsorbed depreciation and unabsorbed capital expenditure and unabsorbed capital expense on family planning. This is a small section. It's a reason section added. If there is a search or survey, definitely department will find out undisclosed income. Against that undisclosed income, current year or brought forward losses or unabsorbed depreciation cannot set off. Otherwise, the search and survey, all those provision will be a waste, because even though department find out certain undisclosed income, assessee will say, I have this much loss. Okay, will set off 0. Then what's the use of search? So that's why they put the condition cannot set off. So these are the major provisions regarding set off of losses under section 78 and 79. Remember, 72A, 78, 79, more important at final level. In case of a restructuring, you have to keep in mind these points. Only those points are all coming together, right? If restructuring during the previous year, restructuring means all those things, right? Amalgamation, demerger, conversion, succession. Fine. If restructuring during the previous year, then depreciation under section 32 to be apportioned between predecessor and successor based on number of days asset held by, used by both of them. We applied in the last question. And now, section 43. The WDV of the predecessor shall become actual cost of the successor in respect of depreciable asset. In case of normal capital asset, not depreciable, as per section 49, predecessor cost of acquisition and holding period can be taken as the successor. That is cost of previous owner, cost of associate. That is 49, non-depreciable capital assets. 43, depreciable asset taken by the new assessee. Old assessees WDV, new assessee actual cost. 47, transactions not treated as a transfer and there is no capital gain. Condition should be satisfied. 72A, predecessor's loss will be allowed to the successor in except speculative loss and unabsorbed business loss and unabsorbed depreciation. In case of demerger and inheritance, only remaining periodic loss is available to carry forward, but in all other cases, the successor will get again fresh 8 years. Under 35 ABA, amortization of telecommunication license fees and spectrum, ABA and ABB. 35D, amortization of preliminary expenditure, 5 equal installments. 35E, development expenditure of a mine under 7th schedule, 10 equal installments. In these 4 sections, there is amortization. But before completing this period, there is a restructuring. Remaining installments available to successor. So, 35D preliminary expense, first 2 years deduction claimed by old company, then amalgamation happens, balance 3 installments can be claimed by new company. So, remaining deduction available to amalgamated or resulting company. So, here it is applicable only for amalgamation and a demerger only they are mentioning. In case of 35 DDA, amortization of VRS compensation paid. If VRS compensation is actually paid to during the previous year, it will be allowed as deduction in 5 equal installments. In that situation, remaining installment available to successor. You see the difference. Sixth point, in the sixth point they are saying ABA, ABB, 35D, 35E, the remaining installments available only in case of amalgamation and demerger. Amalgamated company or resulting company can claim the balance installment. That means if that is a case of succession or succession or conversion, not available. The balance installment lapse. But in the seventh case, that is VRS compensation amortization, remaining deduction can be claimed in all cases of restructuring. Successor, amalgamated company, resulting company, conversion of company into LLP, LLP, property taken by company, company, firm taken by company, company. And MAT or AMD credit of the predecessor not available to successor. 35 AD asset of predecessor taken by successor, actual cost to the successor shall be taken as nil. So these are the overall point. If they are asking a question regarding tax planning with respect to business restructuring, see the major tax planning with respect to business restructuring is loss and capital gain. That is a big area of big four where they are making a lot of money, because whenever there is a large amalgamation or demerger in India between two companies, definitely they need the advice of chartered accountants or these type of tax planning, because crores of rupees of loss and crores of capital gain can be avoided. So it's a very big area. A usual chartered accountant firm can never experience, because we won't get that type of work, only big four. So these are the areas they have to keep in mind at that time. Okay. Now we finished that set of area. We can go to assessment of partnership firm. I think loss questions we finished. First, I will explain the major provisions of partnership firm and LLP. Remember, there are a lot of amendments in partnership firm and LLP. Limits has been changed. So we are expecting a question. Last time they asked. This time maybe not a full question, but we cannot predict. Yeah. So partnership firm. So the speciality of partnership firm or the big tax planning for partnership firm under the income tax law is 40B. So 40B, to get the benefit of 40B, basic conditions firm should satisfy. 194. There should be a written partnership deed and all the partner share must be clearly specified. Along with the first written deed should be submitted. and partnership must be written. So all those conditions satisfied, and it should not make a violations under section 144 best judgment assessment. Then the firm can be assessed as a firm, and this 40B benefit will be available. So to get the 40B benefit, that is interest on capital given to partners and remuneration to partners, what are the basic conditions? To claim interest on capital to partners, primary condition, payment of interest must be authorized by the deed. It should be clearly specified in the deed. And the second one, it should be paid in accordance with the deed. If the deed says 10%, only 10% is allowed. So don't study 12%. If the deed says 10%, 10% is allowed. If deed says 14%, okay, then the other condition will trigger, cannot exceed 12. If the deed says 11%, only 11% is allowed. So it should be in accordance with the deed. It must be for a period after the date of the deed. Meaning, sometimes when the original deed is created, there may not be a clause in the deed providing for interest. Later on, they will amend the deed and interest clause is inserted. In that situation, from the date on which the deed is amended, from prospective period on capital, interest can be provided. With a retrospective effect, interest cannot be given. So that is the meaning. It must be for a period after the date of the deed. So this adjustment applies only in a case where the deed is amended subsequently and interest clause is amended or inserted. So amendment, this deduction is available only from the date on which that amendment came. For example, on 1st December 2024, deed is amended and for the first time provided for interest clause. Interest from 1st December to 31st March, that is total 4 months interest only will be allowed. Even though they provide interest from April, because deed amended on 1st December and inserted interest clause. Rate of interest shall not exceed 12%. Remember, there is nothing mentioned regarding working partner or sleeping partner. So it is a return for the fund invested by the partner. So whether working partner or sleeping partner, no problem. If these 4 conditions satisfied, interest will be allowed. Main condition mentioned in the deed should not exceed 12%. Now exception. Exceptions means even though it is not authorized by the deed, even though it exceeds 12%, no problem. It will be allowed as deduction. Even though it is more than 12% and even though it is not prescribed in the deed, it is available. Exception. A person is partner in representative capacity but received interest in his personal capacity, 40B not applicable. Mr. A is a member of HUF, ABC HUF. ABC HUF is a partner in a firm. So the firm asked every partners to put some additional capital. HUF say, no, we don't have money. At that time, this Mr. A, who is the member of that HUF, he will visit the firm as a representative partner. So Mr. A as an individual, Mr. A is not a partner. But Mr. A is representing his HUF. So HUF is the partner. So at that time, Mr. A is saying, A says that, see, I will give my personal money to the firm, but I need 15% interest. If you are ready, I can arrange you the funds. The firm agreed. This Mr. A, who is the member of that HUF, who is not a partner in personal capacity, is a partner in representative capacity, his personal money given to the firm as a loan or some arrangement, and firm gives 15% interest. No problem. That entire 15% interest will be allowed because it is not an interest given to partner. It is an interest given to just like that of a third party. So it will be allowed. Second one, partner in individual capacity but received interest on behalf of a third party. So sometimes Mr. A is an individual, not a representative partner. As an individual, Mr. A is partner in this particular firm. The firm is asking for additional capital from all the partners. Mr. A says, no, I don't have money. I will do one thing. I have a friend, Mr. Z. He has a lot of money. I will arrange some money from Mr. Z and I will give to the firm. But on condition, he need 15% interest. And he will carry out the activities only through me. So if you can prove that, no problem. The firm can give 15% interest to Mr. A, which in turn given to this third party, no problem. 40B not applicable, entire interest will be allowed, even though specified in the deed, even though it exceeds 12%. So these are the 2 points. So conclusion, interest should be given to a partner as a partner. That's it. Got the idea? Should be given to a partner as a partner. If you are a representative capacity partner, really you are not a partner, 40B not applicable. You are a partner, but getting interest on behalf of a third party, 40B not applicable. That's the point. Interest on capital. So there is a situation, fixed capital method and fluctuating capital method. Fluctuating capital method, only one capital account, no doubt, not confusion. Fixed capital method, there will be two accounts, capital account and current account. Deed mentions only capital account. Deed is silent regarding current account. Then whether the interest can be paid on credit balance in current account as interest on capital. If the deed is silent on current account, it is not allowed. So to provide or to claim interest on capital and current account, it should be specifically mentioned in the deed. If the deed is silent regarding current account, deduction not allowed on interest given to interest on current account. So if these conditions satisfied, interest can be claimed as a reduction while computing the PGBP income of the firm. PGBP income of the firm. And remember, capital includes loan also. If a partner is giving loan to the firm and getting interest on that loan, there is no difference. See, you are the owner. If you are putting capital and loan, not much more difference, right? Both are same. So even though interest is given to partner on capital or interest on loan given by the partner, both same case, same conditions. Now, remuneration to partners. So this part amendment came, right? The limits has been changed. Remuneration, what are the primary conditions? It should be payment of remuneration shall be authorized by the deed. So deed should specifically mention. And number two, it should be paid in accordance with the deed. Authorized by the deed in accordance with the deed. So merge these two provisions, you will get a new one. So the point is either the amount of remuneration or the manner of quantification, mathematical quantification should be clearly mentioned in the deed. Deed says salary can be paid to A and B working partner. Not enough. You cannot claim. Commission will be given to partner C, who is a working partner. Not enough. Salary can be paid 10,000 per month. Yeah, pakka, good. Quantification. Sales into 2% commission can be given. Pakka, mathematical quantification. So there are a lot of cases. Sood Bridge and Associates, Sri Anil Hardware, Durga Das, Devaki Nandan. So in all those cases, High Court clearly mentioned, see, these two provisions, you should take it together. Authorized by the deed in accordance. In accordance, there should be some quantification. So either the amount of remuneration or manner of quantification should be specified in the deed. If it is kept silent, simply saying remuneration, no mathematical quantification or basis of calculation, not allowed, not allowed. And now next one, it should be given only to working partner, and the other condition same, that is it must be for a period after the date of the deed. So that I think that's missing. It should be for a period after the date of the deed, and it should be given only to the working partner. So sleeping partners are eligible for interest on capital, but they are not eligible for remuneration. So working partner means a partner who is actively engaged in the affairs of the firm. Last condition, it shall not exceed the monetary limit prescribed under section 40B. So what is the statutory limit? Maximum limit up to which a remuneration can be paid. So first we have to compute the book profit of the partnership firm or LLP. Book profit here means PGBP income computed under section 28 to 44, and after computing PGBP income, reduce interest on capital and do not reduce remuneration. Do not set off brought forward loss. Do not consider other heads of income. Do not reduce chapter 6A. Current year PGBP computed from section 28 till 44, but after claiming interest on capital, but before claiming remuneration. This is known as book profit. So section 28 to 44 means all the adjustments of PGBP should be applied. Section 28, 41 income should be taken. Section 30, 31, 32, 33 AB, 33 ABA, 35, 35 AD, 35 ABA, ABB, AC, 35 AD, 35 D, 35 DD, 35 DDA, 35 CCA, 35 CCC, and then section 35 D, DD, DDA, 36, 37, 37 2B, and then start with the disallowance 40A1, 40A1A, 40A2, 40A3, 40A4, 40A5, 40 capital letter A2, A3, A7, A9, 43B. All these adjustments you should do. Then do interest on capital. Reduce interest on capital. Do not reduce remuneration because we are computing this book profit for the purpose of remuneration. So do not reduce remuneration. This is book profit. Now there is a very big contradiction happens in book profit computation. I will explain. Always to keep in mind in MCQs, if the question gives book profit, Question says book profit. Do not disturb that book profit because it's computed. Question does not give you book profit but ask you to compute book profit. This point you have to keep in mind. I will show you an illustration. Profit computed under section 28 to 44, rupees 20 lakhs. But before considering unabsorbed depreciation, brought forward unabsorbed depreciation, and before considering brought forward business losses under section 72 subsection 2, 20 lakhs. This is current year, previous year 24-25. Now, brought forward unabsorbed depreciation under section 32 subsection 2 related to assessment year 12-13, rupees 12 lakhs. Now, they have brought forward business loss of assessment year 2021-22, that is rupees 8 lakhs, and for assessment year 22-23, rupees 4 lakhs, or say 5 lakhs. So they considered all other items, 28 to 44, every adjustment they considered. The profit for the current year computed as per income tax law 20 lakhs. But this 20 lakhs they didn't consider brought forward loss and unabsorbed depreciation set off. So book profit defined to mean 28 to 44. So the problem is unabsorbed depreciation section is 32 subsection 2. So which will come in between 32 subsection 2. But brought forward business loss is governed by 72. 72 is not coming within this range. 72 is outside 28 and 44 range. So literally speaking, while computing book profit, unabsorbed depreciation can be set off. But brought forward business loss cannot set off. Unabsorbed depreciation should be set off. You must set off because it is in between 28 and 44. But brought forward business loss you cannot set off because which is outside the limit. Now there is another problem. Book profit says you can set off unabsorbed depreciation. But 72 subsection 2 there is a rules of set off. While you are making the loss set off, first you should give preference to brought forward business loss. Only after that you can set off unabsorbed depreciation. So there is a contradiction. After reducing business loss, you can claim unabsorbed depreciation. But here, you cannot claim business loss. Unabsorbed depreciation should be reduced. So what we will do? So roughly, we have to calculate how much is possible to set off unabsorbed depreciation if we keep the normal rule. So if we keep the normal rule, profit is 20 lakhs. If we keep the order, first brought forward loss set off. Brought forward loss set off is here 8 plus 5, 13. Then balance profit available to set off unabsorbed depreciation is only 7 lakhs. So this we have to find out. And now come back here. So profit 20 lakhs less unabsorbed depreciation. Even though we have 12 restricted to 7 lakhs. So 13 lakhs. This 13 lakhs is known as BP, book profit. Find out the ceiling limit, claim the remuneration, and then unabsorbed depreciation will be add back, business loss will reduce, then last we will reduce unabsorbed depreciation. So this should be the computation if they are giving current year profit before setting of unabsorbed depreciation and before setting of brought forward business loss. We can set off unabsorbed depreciation but subject to that limit because of the restriction in set off condition. First we should claim brought forward loss set off and balance profit against which only we can set off the unabsorbed depreciation. So this rule we should keep in mind. Okay, now we can come back. So we got the book profit. Suppose if it is negative, no problem. Even the loss, a firm can give a remuneration up to rupees 3 lakh. So if the firm incurred a book profit, not a positive income, it's a loss. Total income computed, PGP income computed as per 28 to 44 is a loss. Okay, no problem. Claim remuneration up to 3 lakh. So if it is positive, okay, if it is positive, we have to make it into 2 slab. So first up to the first 6 lakhs of book profit, 90% of book profit or rupees 3 lakh whichever is higher, and for balance book profit 60% of the profit above 6 lakhs, because up to 6 lakh first slab and second slab above 6 lakh second slab 60%. So this is the ceiling limit. So total remuneration, actual remuneration paid or payable to working partner or ceiling limit, whichever is less deduction. So actual remuneration paid or payable to working partner or ceiling limit, whichever is less deduction. So once we claim this deduction, that is the current year PGBP income of the firm. Now we can set off brought forward loss. And if you have unabsorbed depreciation already set off, add back and then claim it is last. Then brought forward loss. So after remuneration, you can set off brought forward business loss. So this is the way book profit is computed for a partnership firm. Now, if the book remuneration is given to a technically qualified partner, and partner is say, see, I am a technically qualified person. If you appointed a person as a employee, you have to pay salary. So instead of doing that, I am technically qualified, I will do the job, give me salary separately and do not consider it as a remuneration. No, that is not possible. Then every partnership firm can be created with the technical experts as partners and their entire remuneration can be paid by salary. So that is not possible. Even though partner is a technically qualified person and getting remuneration from the firm, it must be treated as remuneration to partners and it must be come under the limit of 40B. Compulsory. So even though partner is technically qualified, any remuneration paid is within the purview of section 40B. The next issue, as per the provisions of section 40 capital letter A subsection 2 of the income tax law, whenever a payment of expenditure is made to relatives or substantially interested persons, it should be made at a fair market value. If it is excessive or unreasonable compared to the fair market value, the excess should be disallowed as per section 40 capital letter A subsection 2 to the extent of that excess amount. Partner is a related party for the firm. So if partnership firm or LLP is giving remuneration to a partner, definitely it is a related party transaction. So if it is a related party transaction, if we apply 48(2), probably there is an issue. This remuneration may be compared to the market rate. A similar person of a private company MD, he is getting salary only 2 lakh per month. This partner is getting remuneration 5 lakh per month. So if we compare to the market, it is excess. We have to apply section 48(2). In such a scenario, if we apply section 48(2), then why legislator created 40B? Then what is the purpose of 40B? The very purpose of 40B will be defeated. So they clearly mentioning 40B is a self-contained provision created with the clear intention to get the benefit by every firm and LLP which follows 40B and satisfy all the conditions. They will get this deduction. So on that amount, that remuneration, if we apply the general disallowance of 48(2) disallowance, then the purpose of this section will be defeated. So the conclusion, 48(2) disallowance is not applicable on 40B remuneration. Similarly, 48(2) cannot be applied on interest also. Sometimes AO will say, bank rate interest is only 10%. Why you are paying 12% interest on capital and 2% we are going to disallow? No, not possible. So interest on capital to partners and remuneration to partners cannot be disallowed by applying section 48(2). If it is within the purview of 40B and satisfied all the conditions, then it should be allowed. It should be allowed. And whatever remuneration and interest on capital received by the partner from the firm, it will be treated as PGBP income in the hands of the partner, and partner should declare it in his ITR, and he must show as PGBP income, because what is allowed to the firm is income of the partner. What is disallowed to the firm, not an income of the partner. So even the partner is getting 14% interest on capital, only 12% will be allowed to the firm. So partner's income is only 12, not 14. Even though he is getting 14%, only 12% will be taxable. So allowability to the firm, taxability of the partner. And finally, the firm will distribute the share of profit that is exempted in the hands of the partner as per section 10(2)(a), because share of profit is exempted. Already firm paid a tax and then distribute. It will amount to double taxation. That is why it is exempted. If firm is liable for tax audit, remember, if firm is liable for tax audit, definitely the due date for filing ITR of firm will be October 31st. In those cases, all the partners, whether sleeping or working, the partner's personal ITR due date will be October 31st, because only after finalizing the firm's books, partner's income can be finalized. That is why whether sleeping partner or working partner, always the due date for the partner will be October 31st if his firm or LLP liable for tax audit. And if a firm or LLP is opting for 44AD presumptive taxation or 44ADA, as you are aware, 44AD and ADA presumptive taxation is available for partnership firm, but it is not available for LLP. Remember, it is not available for LLP. Resident individual, resident HEF, resident partnership firm engaged in any business and the turnover does not exceed rupees 2 crore or 3 crore and not engaged in ineligible business, they can opt for 44AD. If they declare income under 44AD, that is 8% of gross turnover or 6% of gross turnover. From that income, they cannot claim this remuneration and interest on capital, etc. That's totally prohibited. Whether in AD or in specified proportion ADA, it is not possible. But remember, if 44AE, partnership firm or LLP engaged in hiring or leasing or plying of goods carriages that does not have more than 10 goods carriages during the previous year, they can declare income under 44AE. Heavy goods carriage rupees 1000 per ton per vehicle per month or part of the month. Other than heavy goods vehicle 7500 per vehicle per month or part of the month. Against that income, there is no similar prohibition. They can claim 40B. AD and ADA not possible. And tax rate of a partnership firm or LLP for normal income, it is taxable at 30%. And if the firm has long-term capital gain, flat rate, 111A flat rate, lottery betting gambling flat rate 30, and if they have a virtual digit less than 115 BBH, a flat rate 30%. So normal income of a partnership firm and LLP, whether it is resident or non-resident, the tax rate is 30%. And if the total income of the firm or LLP exceeds 1 crore, then surcharge will be 12%. There is no differential surcharge for firm and LLP. Only for company, total income 1 crore and 10 crore 7% and exceeding 10 crore 12%. Foreign company 2% and 5%. But for firm and LLP, 12%. Individual, the surcharge is different, 10%, 15%, 25% and 37%. And under default tax regime, 10, 15, 25. Now 37 under default tax. So this is a tax liability. And other assessment related provisions you have to keep in mind while trying a problem on partnership firm. Earlier we discussed. Whenever a partner is going out of the firm, either by way of retirement or death, outgoing partner's share in the losses of the firm shall not be allowed to carry forward or set off to the firm. It should be eliminated. Nobody will get that loss. But this rule is not applicable for unabsorbed depreciation and unabsorbed capital expenditure on scientific research or family planning. One more additional point. In addition to 40B and all these things, one point. And second point, if a capital asset is transferred by a partner to the firm, capital gain arises to partner. Full value of consideration of the partner shall be book value, that is value entered in the books of accounts of the firm for that asset. Subsequently, if that asset is transferred by the firm or LLP, its cost of acquisition shall be such book value entered in the books of the firm. As per 45.4 and 9B, we already studied. 9B, firm will be. So in addition to a normal typical PGBP and all heads of income problem of a firm with the 40B remuneration, they can add this adjustment 9B and 45.4. Then the question will be very big. They will give 40 marks. They can ask a compulsory question based on like that. They can add all these things. And then ICDS 2. This is also very, very important. ICDS 2. At the time of dissolution of a partnership firm and dissolution of a limited liability partnership, as per income computation disclosure standards 2, the closing stock of the firm should be valued at NRV, net realizable value only, or fair market value only. Normally, the stock is valued at a cost or NRV, whichever is lower, but that rule is not applicable in case of dissolution of a partnership firm. Sometimes after dissolution, the firm may continue the business with the reconstituted partners, but sometimes they may not continue. See, whether or not the business is continued, in case of dissolution of a firm or LLP, closing stock should be valued at NRV only. Then 47, some of the provisions of conversion of company into LLP, or similarly firm is taken by a company succession, all those things we discussed. If the firm or LLP claimed section 10AA special economic zone deduction, or section 35 OD specified business deduction, or chapter 6 heading C, that is section 80 IAB or IAC or IB, IC, ID, IE, IAC, 80 JJAA. So if they are claiming such a type of chapter 6 heading C reductions, not 80 GG, also, that's not a problem, right? Heading C reductions, basically 80 IAC, 80 IAB, double J double A. 80M is only for company, right? So these three, basically, under heading C. And 35 AD, specified business. 10 AA, special economic zone. Definitely, they are liable for alternate minimum tax under section 115 JC. Because AMD is applicable only for those assessees who are claiming any one of these incentives. All other persons are not liable for AMD. So firm and LLP liable for AMD if they claim any one of these deductions. When a company converted into LLP, the unutilized MAT credit of the company not available to LLP. Even though LLP liable for AMT, they cannot utilize the MAT credit of the company. It will lapse. So these are the theoretical point you have to keep in mind regarding the partnership firm and LLP. So this is very, very important. So now we can take a break. And after the break, we will start the questions on assessment of firm. So in between assessment of firm, I will explain 10 AA and 35 AD. Starting assessment of firm. Question number 23. So MNO Corporation LLP is carrying on two businesses: textile manufacture and operation of cold chain facility. Remember, cold chain facility is a business covered under section 35 AD. It gives you the following information for the year ended 31st March 2025. Net profit as per P&L account. They are giving two net profits separately. From textile manufacture 10 lakh 25, from operation of cold chain facility 20 lakh 50,000. Following items are debited to profit and loss account. Interest on capital payable to partners at a 15% on total capital of 100 lakhs. Working partner salary rupees 36 lakhs, that is 1 lakh each per month for 3 partners. Depreciation on textile factory building 5 lakhs. Depreciation on plant and machinery of textile business 35 lakhs. Keyman insurance policy premium paid 1 lakh 55,000. These are the items debited to PL. But the net profit is given separately. Then they are saying what are the items debited to general P&L. Other information. Eligible depreciation under section 32. So the earlier depreciation is as per books. As per 32, plant and machinery of textile business 27 lakh. Factory building related to textile business 4 lakhs. Obviously, the other business is 35 AD, so there will be no depreciation, right? Because entire cost we will claim under 35 AD. There will be no depreciation. Depreciation only will be textile. Next paragraph, the assessee set up and operating a cold chain facility since 1st April 2023. Cold chain, that 35 AD business not in the current year. It incurred a capital expenditure towards construction of cold chain facility during the period from 1st January 23 to 31st March 2023. As under. Land acquired 30 lakh. Cost of construction of building and machineries installed till 31st March 23, 50 lakhs. The income of the firm for the previous year 23-24 is given below. That is last year details. Actually, that paragraph completely deals with the last year details. Income from textile manufacture last year 12 lakhs. Income from cold chain facility 35 lakhs before deduction under section 35 AD. So first paragraph completely current year. Second details completely last year with the 35 AD. And third paragraph next adjustment. The firm originally had 4 equal partners and 1 partner retired on 31st March 2024. 31st March 2024 means beginning of the current year. 23-24 last. 24-25 beginning. The partnership agreement authorizes payment of salary and interest on capital which are debited to P&L. You are required to compute the total income of the firm for assessment day 25-26. Ignore AMT under section 115 JC. Even though they are not saying ignore AMD, there is no AMD in the current year. Because to attract AMD in the current year you should claim 10 AA or 35 AD or heading C. So current year they are not claiming 35 AD because they started 35 AD in last year. So last year the entire capital expenditure except cost of land, cost of financial instrument, except cost of goodwill. All other capital expense incurred for 35 AD, they would have been claimed in last year. Okay. So even though they are saying not there is no AMD, actually there is no AMD. So now the problem is there are two business, textile and cold chain. One is normal business, another one is 35 AD business. Current year, both business has profit. So some other expense is also given, and it is a firm. Interest on capital is there, remuneration is there, 40B is there. The next issue, last year they started 35 AD. There is a provision as per section 73A. If there is a loss from 35 AD business, it can set off only against 35 AD income. So last year, we have to go to the last year, we have to check whether there is any loss in last year under 35 AD. If there is a loss, that loss we can set off only against income from 35 AD business for the current year only. We cannot set off with the textile. It can set off only against the cold chain. So that is the first issue. And there is another issue. One of the partner is going out of the firm. So section 78 will be applied. 4 equal partners. So one partner share is 1/4, or we can say 25%. One of the partner is going out. So if last year there is a loss, out of that loss, this outgoing partner share must be eliminated. And remaining 75% of the losses only will be allowed to carry forward to the next year. And if that is 35 AD loss, it can set off only against the current year 35 income only. So a lot of issues. And the next issue, that is a big issue. Current year, this LLP have two divisions, the two business, textile and cold chain. Both are belong to a single LLP. So how we will find out the book profit? How we will find out the remuneration? So this book profit concept and the remuneration is for a firm or LLP as a whole. As a whole. It is not for each business separately, not available. If a firm have multiple business, the combined profit is known as the book profit. So for the current year, textile and the cold chain, we have to find out the combined book profit, PGBP income, combined book profit. Then reduce the remuneration and interest on capital, we will get the taxable income. And from that taxable income, again, we have to split cold chain and textile, because we have brought forward a loss from cold chain that can set off only against the current year's cold chain income only. So from where we will start. So first we will go to the last year to find out the loss in the last year. So previous year 23-24, they have cold chain business. The profit from the cold chain business in the last year before 35D deduction is 35 lakhs. Less deduction under section 35 AD. So last year they incurred capital expenditure for this specified business. They are given cost of land 30 lakhs, not eligible under section 35 AD. Cost of land, cost of financial instrument and cost of goodwill not eligible. All other capital expense eligible. So cost of construction of building and machineries 50 lakhs eligible. So last year there is a loss. That is section 35 AD loss. This 35 AD loss of 15 lakhs, we cannot set off with the last year's called textile profit. We cannot set off because that is not a 35 AD. So under section 73A, we cannot set off with any other business. It should be carry forward. But when it is carry forward, the problem arises as on 31st March 2024, one of the partner is going out. So section 78. As per 78, only 75% of, that is 25% not permitted. 75% of 15 lakhs only will be allowed to carry forward to next year. What is the amount? 15 lakhs into 75%. 11 lakh 25,000. Yeah. So last year the things are clear. We got the eligible brought forward losses 11 lakh 25,000. Now come to the current year. So current year we have to find out the book profit. Remember, book profit and remuneration, all those concepts are assessees total, right? Total business together. So first to find out the current year's combined net profit we can find out. So net profit from textile 10 lakh 25,000. Cold chain 20,50,000. So total 30,75,000, correct? This is combined net profit. Add interest on capital payable to partners allowed only up to 12%. They are debiting 15%. So excess interest, excess of 12%. So 100 lakhs into 3%, that will come to 3 lakhs, right? See, to find out the book profit, if remuneration already debited, they should add back. So working partner salary, remuneration debited to P&L, 36 lakhs should add back. Depreciation, all these are depreciation as per accounts. 5 plus 35, total 40 lakhs. Keyman insurance policy premium, no problem. It is allowed as an expense under section 37. It is a general deduction. If an employee is an important employee for the organization, that person is known as the keyman. If the company taking an insurance to insure that particular person and premium paid by the company, no problem. Absolutely, it's a business expense allowed under section 37. So no disallowance. Simply put a not allowed under 37. So no disallowance. Reduce 32 depreciation. So what is the total of this? Total 1 crore 9 lakhs 75,000. 1 crore 9 lakhs 75,000 and reduce the depreciation under section 32. 27 plus 4 30 1 lakh, right? We got the combined book profit BP. What is it? Combined book profit 78 lakh 75,000. Once we got the combined net profit, simply find out the ceiling limit. So 78 lakh 75,000. So first 6 lakhs into 90%, 5 lakh 40,000. And balance 78 75 minus 6 means 72 75 into 60%. This will be 40 49.0 72.75 into 60%. 43 lakhs 65,000. Yeah. So the limit 43 65 plus 540. 49 lakhs 5,000 is the ceiling limit. Actual remuneration debited to P&L we added, that is 36 lakhs only, so that is allowed, or 36 lakhs, whichever is lower is the deduction allowed. So less. Section 40B, remuneration allowable 36 lakhs. So what is the PGBP, combined PGBP income of Coldgen and textile? 42 lakh 75,000. So we have a brought forward losses of 73A from 35 AD business 11 lakh 25,000. But that 11 lakh 25,000 we cannot set off with this one, because this 42 lakh 75,000 includes textile business profit also, Coldgen also. So we need the exactly what is the profit from Coldgen. Then only we can make the set off. Set off is making after remuneration, interest, every deduction. After computation of all these things, we have to set off. So that is 4275. But the problem is we don't know exactly how much is the Coldgen profit included in this 4275. So we have to find out separately. So that is a very difficult task. So we can do one thing. Whatever data they are given separately for textile and Coldgen, based on that, we can either find out taxable income of textile unit out of this 4275. Once we got that, if that is reduced, remaining will be cold design. Or we can find out cold design. If that is reduced, we will get textile. Here the limited adjustments are applicable only for cold design. So better to first find out the cold design business income out of this 4275. So how that will be find out? So what is the net profit of cold design? So net profit of cold design is 20 lakh 50,000. So can we make any specific disallowance related to cold design? See, first disallowance is excess interest. How we can say this interest disallowed 3 lakh, that is excess of 12%, whether it is disallowed in textile or cold design, it is very difficult to say. There is no other basis is given. In the absence of any other data, it is assumed that this excess 3 lakhs is disallowed in the ratio of net profit ratio. In these two businesses, it is disallowed on the assumption. It's purely an assumption. The best suitable basis is net profit ratio. If they given some other basis, you can take that. The absence of any other data, I am taking the assumption. So net profit ratio 10.25 is to 20.5. That is a ratio. In that ratio, we can disallow the interest. So for cold design, net profit is 20.5. Textile 10.25. So based on that ratio, excess interest should be disallowed. So interest disallowance 3 lakhs divided by 30.75 into 20.5. How much? 2 lakhs. So that adjusted. And now working partner salary. That is remuneration is add back or disallowed. So how we can say this remuneration is disallowed in textile or cold design, whether we should take the ratio. Usually we will take the ratio, but here no need to do that, because in this 42,75,000 there is no disallowance of remuneration, because entire actual remuneration is allowed as deduction. You see, here we added 36 lakhs and here we reduced 36 lakh. So this 42,75,000 has no impact. So no need to add back. If there was a disallowance in working partners remuneration, then definitely that should also be taken on the basis of this ratio. Depreciation, that exclusively belongs to which unit? Textile. Reduced depreciation also belongs to which unit? Textile. So we got it. So out of this 42,75,000, profit of cold chain is 22,50,000. Simultaneously, you can try to find out the taxable income of textile. You will get the same answer. Right? If you reduce 22.5 out of 42.75, remaining will be textile. Okay. So now we can find out take the final answer. Less brought forward loss set off under section 73A. Last year we have a brought forward loss of 11,25,000. That 11,25,000 made a set off. So what is the PGBP income from cold chain after set off of losses? 11,25,000. So what is the profit of textile? So textile profit is 42,75,000 minus 2250. What is that? Textile 42,75,000 minus 2250,000. 20,25,000. And cold chain we find out 11,25,000. This is the total income of the assessor. How much? 31,50,000. So if a question contains this combined net profit concept, remember the deduction is as a whole, assessee as a whole, right? Entire assessee, what is the total profit? From that you can claim the remuneration and the deduction, not business wise. The only assumption we need to take is the disallowance towards textile and cold chain is based on net profit ratio. In the absence of any other data, there is no other way we will take like that. Yeah. Going to question number 24. So I'm reading the question. That actually that question is a conversion of company into LLP and assessment of LLP. So we have to compute the taxable income of LLP. But remember, keep in mind, it is not a LLP started as an LLP. Earlier it was a company. That company is now converted into LLP. So on 1st April 2024, Binu Limited of Delhi, a domestic company, engaged in the business of manufacturing of metro rail seats. It's a manufacturing company. Converted into an LLP by name Saumya LLP, fulfilling all the conditions specified in section 47 13B of the Income Tax Act. Some of the relevant information is given below in respect of Binu Limited as on 31st March 2024. VRS, voluntary retirement scheme, expenditure incurred by the company during the previous year 20 to 23 is rupees 20 lakhs. The company was allowed a reduction of rupees 4 lakh each for the previous year 22 23 and 23 24 under section 35 DDA. If a private company converted into LLP and that private company claimed a reduction under section 35 DDA in respect of VRS compensation paid in 5 equal installments, what is the remaining installments available that is possible to claim by the LLP? So here only 2 installments claimed by company, 3 installments are remaining. So for the current year's installment of 4 lakhs rupees can be claimed by LLP for the year 24-25 because 24-25 is the third year. Total 35 DDA deduction available in 5 years. 2 years already they claimed. 20 lakhs divided by 5, 4 lakhs each. So 2 installment claimed. So current year, the share of 35 DDA 4 lakh can be claimed by LLP. Second, 150 equity shares in Toyo Limited, an Indian company listed in Bombay Stock Exchange, was acquired for rupees 1900 per share on 31st July 2017. On conversion, these shares become the property of Messrs. Saumya LLP. We have to write 2 notes. First note is at the time of conversion of company into LLP, if the capital assets are transferred by company to LLP, it is not a transfer as per section 47. Accordingly, while transferring these shares to the LLP, there is no capital gain. But the current year, if LLP transferred these shares, there will be capital gain for the LLP. At that time, cost of acquisition of Toyo Limited cost of acquisition of Binu Limited will be treated as cost of acquisition of LLP. Third, besides other assets transferred to Messrs. Saumya LLP by Messrs. Binu Limited, it also transferred 2 factory buildings. On 1/4/2024, Messrs. Saumya LLP leased out 1 factory building along with the plant and machinery and furniture at a consolidated lease rent of rupees 50,000 per month. So, besides other assets, Binu Limited also transferred 2 factory building, but LLP did not use that factory building for its business purpose. Instead of that, they are let it out. So, if the business assets is let it out, then that consolidated lease rent will be taxable under the head income from other source. So, this lease rent will be taken under income from other source in the hands of the LLP. Now, during the previous year 24-25, okay, the next details are the details of the LLP. Saumya LLP earned a profit of rupees 25,40,000 after debit or credit of the following items to its P&L. Mr. Binu is the working partner of the LLP. He is also a working partner in another firm. He is actively engaged in the business of both the firm. Binu gets a salary of rupees 55,000 per month from Saumya LLP, and the same is authorized in the deed of LLP. Question says after debit or credit. So the remuneration is debited to P&L. So it should be add back. So 55,000 into 12, we have to add back. And then after that, we will find out the book profit. Then we will compute the ceiling limit. Then we will compare. Then we will claim. So now it should be add back to find out the BP. Mr. Aishman, an employee, was deputed to work in the client's office in Mumbai for 3 months. The LLP has paid his salary in cash for the months when he was in Mumbai, amounting to rupees 3,45,000 net of TDS and other deduction, since he did not have a bank account in Mumbai. This payment was included in amount of salary debited to P&L. Mr. Ayushman is normally posted in Delhi, being the headquarters of Messrs. Soumya LLP. As per the provisions of Rule 6DD, if an employee working in a place other than his normal place or working in a ship for more than 15 days, and as there is no bank account at that place, his salary can be paid in cash without disallowance under 40A3. So it's absolutely allowable, but subject to TDS. TDS is deducted, so no problem. It is allowable. No disallowance. No disallowance. Rule 6DD. Amount of rupees 25,000 was paid towards penalty for non-fulfillment of delivery conditions of a contract for sale for the reasons beyond its control. There is a provision under section 37, explanation 1, explanation 2, explanation 3. If we read explanation 1 along with explanation 3 of section 37, any expenditure which is illegal in nature or public offense or prohibited by law or contravention of law or violation of law or breach of law is to be disallowed, not allowed. But remember, if you scrutinize that provision, which clearly says breach of law, contravention of law, here it is not a breach of law, it is a breach of contract. As a businessman, definitely you have to breach sometimes some contract. Then it will happen naturally. So no problem. It is allowed. It is not an item covered under explanation 1. It is a breach of contract, not a breach of law. So it is allowed as a deduction under section 37. Under section 37, it is allowed. Because the word is not fulfillment of delivery conditions of a contract for sale for the reasons beyond control. That's not a law. Allowable, no adjustment is required. The LLP had provided an amount of rupees 18 lakhs being the sum estimated as payable to workers based on agreement to be entered with the workers union towards periodical wage revision once in 3 years. The provision is based on a fair estimation of wage and reasonable certainty of revision once in 3 years. Actually, this is a provision of ICDS. As per ICDS, when you create a provision, it will be allowed subject to 2 conditions. There should be a reasonable certainty should be there, and the amount should be able to estimate. So here the amount can be estimated, and there is, it clearly says there is a reasonable certainty of revision once in 3 years. So now it is once in 3 years revision is made. So this provision is allowable as per ICDS. Even as per accounts also allowable, as per ICDS also allowable. So no further adjustment is required. So it's a provision regarding ICDS. That is ICDS 10. ICDS 10. So it is allowable. So no adjustment is required. First of all, there should be reasonable certainty, that is satisfied. And second one, the amount should be able to estimate. That is also possible. So no problem. Allowable. If there is no reasonable certainty, only probability, only probable, definitely we will add back, disallow. Depreciation debited to P&L accounts, add back. 5,40,000 we have to add back. Gratuity provisions based on actuarial valuation rupees 6.5 lakhs. Gratuity actually paid 4 lakhs to retired employees debited in gratuity provision account. Okay. Specific disallowance, section 40, capital letter A, subsection 7. As per 40A7, provision for gratuity debited to P&L, whether as per actuarial valuation or any other technical valuation, it is absolutely an expense to be disallowed. It should be add back. So 6.5 lakhs to be disallowed, 40A7. But if you actually paid gratuity, the liability is sure, expense is incurred, that you can claim. So add back 6.5 lakhs, reduce 4 lakhs. Add 6.5 lakhs, reduce 4 lakhs. 40A7. Profit on sale of shares of Messrs. Toyo Limited. Yeah. So the shares which got transferred from the company is now transferred by the LLP. So there is a capital gain. Remember, it is listed long-term equity 112A. So transferred at rupees 1,27,500. These profit on sale of shares directly they are given. We have to make the computation to ensure that it is correct. These shares were sold on 31st May 2024 for rupees 2,750 per share. Highest price of Toyo Limited quoted on the stock exchange on 31st January 2018 was rupees 2,500 per share. That is the fair market value as on 31st January 2018. So the full value of consideration is 150 into rupees 2,750. That is full value of consideration. 150 into 2,750. That is the full value of consideration. And then we have to reduce the cost of acquisition. We have to make the comparison. Original cost. If you take per unit, original cost 1,900, and then fair market value 2,500. Full value of consideration 2,750. 2,750 or 2,500, whichever is lower is 2,500. 2,500 or 1,900, whichever is higher, 2,500. That is the cost of acquisition as per 112A. So 2,500 and 2,750, the difference per share, capital gain 250. 250 into total number 150. So 250 into 150, 37,500. Up to 1,25,000 long-term capital gain under section 112 is nil. So there will be no need to pay the tax. But anyway, now we have to reduce this 1,27,500 from the net profit, because question start with after debiting or crediting. So it's already credited. This 127,500 we have to reduce and then go to capital gain, make the capital gain computation. That will become to rupees 37,500. And at the time of computing the tax, we will say up to 1.25 nil. This 127,500 is the capital gain computation as per accounts purpose. As per accountancy, that may be correct. But income tax, it should be taxable under capital gain and not this is the figure. So now we have to reduce 127,500 from net profit. Repairs to plant and machinery include rupees 59,000 in respect of plant and machinery given on lease. Actually, if the plant and machinery and factory building is let out, that income will be taken to income from other source. So this expense can be claimed in income from other source. So now we have to add back this 59,000 repair on plant and machinery related to leased plant and machinery, have to add back here. And remember, this 59,000 you must claim under IFOS against that lease rental income. Here we have to add back. Factory license fees paid 15,000 for each factory building. Actually, these factory buildings are let out by Soumya LLP. So this should also be an expense under income from other source. So here we have to add back. And it should be claimed under IFOS. Legal fees includes 26,000 paid to an advocate for drafting and registering the lease agreement. Same, add back and take it to IFOS and claim it there. Additional information. Under an agreement of debt restructuring, the bank has converted unpaid interest amounting to rupees 9 lakh up to 31st July 2024 into a new loan account repayable in 3 equal annual installments. The first installment was paid in March 2025 by debiting the new loan account. So, as per explanation to section 43B, if arrears of interest is converted into a fresh loan, it will not be treated as a payment. Accordingly, it cannot be claimed as a deduction. But once you actually paid that converted interest into a loan and that loan is paid, it will be equal to payment of interest. It is a bank interest. Bank interest is covered under section 43B. As per 43B, bank interest will be allowed only if it is actually paid either during the previous year or at least prior to the due date for filing ITR. But if arrears of bank interest is converted into fresh loan, that conversion itself is not a payment. Only when that converted interest is actually paid, it will be allowed as a reduction. So out of this 9 lakh, he actually paid 3 equal installments. The new loan payable in 3 installments, and this year he paid only 1 installment, right? The first installment. So 9 lakh by 3. 9 lakh by 3 means 3 lakhs. So 3 lakhs he can claim as deduction now. It's not debited to P&L. It is given in the further information. And this payment is debited to loan account, not in P&L. So we can reduce less from net profit less 3 lakhs. 9 by 3. 1 installment is paid. Paid installment can be claimed. Explanation to 43B. Reduce 3. Balance 6 lakhs you can claim only when it is paid in subsequent year. Mr. Binu, being a working partner, bought a car which is registered in his own name out of the funds of LLP. The car was used exclusively for the purpose of the business of the LLP only. The depreciation of the car amounts to rupees 15,000 for previous year 24-25, which is not included in the depreciation amount debited to profit and loss account. As per section 32, to claim depreciation, registered ownership is not compulsory. Beneficial ownership is enough. ICDS Limited Supreme Court, Podar Cement Limited Supreme Court, Metalman Auto Private Limited Supreme Court, Shivagami and another High Court. So a lot of cases are there. So registered ownership is not compulsory. Beneficial ownership is enough. This rule is applicable for road transport vehicles and building. So here it is a car. So usually car cannot be registered in the name of a partnership firm. That is an artificial name. As per motor vehicle registration requirement, the car must be registered in the name of a natural person. So that is why companies are registering vehicles in the name of MD or director or manager. No problem. The cost is incurred by the company. The car is used for the purpose of the company. So company can claim depreciation. No problem. So this 15,000 depreciation we can claim. Depreciation as per income tax rules 8,10,000, including depreciation on the assets given on lease amounting to rupees 90,000. Yeah, that is a problem. That 90,000 depreciation should be debited in income from other source. Under income from other source, as per section 57, you can claim depreciation. If assets, business assets are let it out, lease rent is taxable under section 56, income from other source. At that situation, against that income, you can claim current repair, insurance premium, even municipal tax, and even depreciation. Normal depreciation under section 32 can be claimed under IFOS. The expense side of PGBP and IFOS almost same. But you cannot claim additional depreciation in IFOS, but normal depreciation you can claim. So this 90,000 related to that leased assets. So this 90,000 here we cannot claim. So here the depreciation is, as per income tax depreciation is 8,10,000 minus 90 plus 15,000. What is that 15,000 depreciation car? That is a total depreciation allowable under the income tax that we can reduce less. 8,10,000 minus 90 plus 15,000. And this 90 you can claim under income from other source. They're clearly saying it does not include depreciation car. Fourth, the LLP sold import entitlements on 1st May 2024 for rupees 1,50,000. This sum is not included in profit and loss account by treating it as a capital receipt. It is a specific item related to chargeability of PGBP section 28. If the assessee engaged in export business or similar business, profit on sale of import license, duty drawback, cash compensatory support, this type of export benefit should be taxable under PGBP as an income. So it is a PGBP income. They didn't consider it, so we have to consider. So 1,50,000 should be added to net profit. 1,50,000 should be added to net profit, business income section 28. You are required to discuss the implication of such a conversion and calculate the total income in the hands of Saumya LLP for the assessment at 25-26. They are asking calculate total income, right? So we have to first find out the book profit, reduce the remuneration. You will get the PGBP, then go to IFOS, then go to capital gain, take the GTI. Now chapter 6A, that is a total income. Okay. You completed? Now the primary adjustments, VRS, balance 4 lakhs you have to reduce. In PGBP, we have to reduce 4 lakhs, 35 DDA. So actual remuneration 55,000 into 12. How much? 6 lakh 60,000. What is the depreciator section 32? That is 810 minus 90 plus 50. Yeah, we'll get BP. Book profit. It is correct. 2677,500. For business, I think all the adjustments we considered. Yeah, sure, sorry. No, that is 4 lakh, correct. So here it is 20. Yeah, correct. Yes. So BP is correct. No. Provision for gratuity should be disallowed. No. Do not make that net adjustment, because provision for gratuity is a specific item to be disallowed. 48(7). But when the employee actually retired and you paid gratuity, claim it. So you should shown us 2 adjustment. Provision for gratuity should be added. Gratuity actually paid should be reduced. If you take the net figure, answer will be same. But I'm saying that is not correct. Presentation is not good. Add provision for gratuity, put not on 48(7), then reduce gratuity actually paid. BP is correct. 2677,500. It's correct. 2677,500. If it is wrong, other calculations will be wrong. That's why I'm waiting, right? What is the ceiling limit? 17 lakh 86,500. Actually 6 lakh 60. So actually it's lower. We got EGPP. How much? 20 lakh 70. AFOs we have to compute separately. Lease rent 50,000 per month, 6 lakh. Expense we can claim repair, license, legal. Any other expense? Repair, factory, license, depreciation. 90,000, right? So what is IFOS? 4 lakh 10,000. Yeah. No capital gain. How much? 30, 37, 500. Calculation should be shown separately for capital gain. 112A. Now chapter 6A. So this is the total income of the LLP. $24 lakh, 60. When you are writing for examination, all these adjustments should carry at least 2 sentences. You must write the provision in detail. Once doing the problem, along with the solving the problem, put every notes in there only. See, after completing problem, if you are showing working notes separately, you won't get the enough time. It's very time consuming, right? Even MCQ is also case scenario. It will take a lot of time. So don't do that. So put every adjustment. If there is no adding or less, just put dash. But that adjustment note should be written there. So that value also it's easy for him. If there is additional information number 1, 2, 3, you can put like this additional information 1, A1, A2, A3 like that you can put. So all other adjustment put that same number. If one item is add, another is less, no problem. That number you can put under less. So notes are very, very important. So 2, 3 sentences for every adjustment you have to put the note. So if possible, try to write the section number also. So next we have to discuss 10AA. So without studying 10AA, we cannot do the next question because next question comprise 10AA SC and it is an LLP, book profit, and there is AMD. Everything is there. So we do first we will discuss special economics on deduction 10AA. Then we will come back to that question. Any doubt on this question? It's a typical question. You can expect like this type of size question. You can expect for compulsory question. So 10AA deduction for special economics on SEZ unit. So assessee should start a new manufacturing business or as a providing service in a special economic zone on or after 1st April 2005 but before 31st March 2020. But if the letter of approval from Development Commissioner obtained before 31st March 2020 but we started business after 31st March 2020 but before 31st March 2021, no problem, you are eligible. So normally the cutoff date is 31st March 2020, but it will be available just one more year, but there is a strict condition. Your letter of approval should be before cutoff date, that is 31st March 2020, because there may be delay in starting the business, but approval has been obtained before the cutoff date, you are eligible to claim 10AA. So either you should engage in manufacturing a goods and exporting to outside India, or you should be engaged in providing a service. Service means it may be development of software and exporting, or any other service is also eligible. Even development and export of computer software is also covered under this section. Okay, it must be a new business. To start a business under 10AA, to claim section 10AA deduction, remember, it must be a new business. Out of the total plant and machinery used in that business, at least 80% of the plant and machinery must be new. Up to 20% of the total plant and machinery requirement, you can use second-hand plant and machinery or used plant and machinery. If you are using imported second-hand plant and machinery, then it will be treated like new. That will not be treated as a used plant and machinery. Under section 32, while we are claiming additional depreciation, if it is an imported second-hand plant and machinery, not eligible. But in 35 AD and 10AA, imported second-hand plant and machinery, but Assassi is the first user in India, it will be treated as new in 10AA and 35 AD. But under section 32, for the purpose of additional depreciation, it must be new plant and machinery, even though it is imported second-hand and we are the first user in India, not eligible. What is the benefit? For the first 5 years of operation, 100% of the eligible profit, or we can say export profit, 100% of the export profit is allowed as deduction. And from 6th year to 10th year, 50% of eligible profit or export profit is allowed as deduction. And for the 11th to 15th year, 50% of export profit, eligible profit, or amount transferred to SEZ reinvestment reserve account, whichever is lower, deduction can be claimed. And this SEZ reinvestment reserve account can be utilized only for purchase of eligible plant and machinery, and it cannot be used for declaration of dividend. That reserve cannot be used for creating asset outside India, and there are a lot of other conditions also prescribed. That's not required. So now 5 plus 5 plus 5, total 15 years you will get the benefit under section 10AA. So this is SEZ deduction. How the eligible profit or export profit will be computed? To get the eligible profit, first we should compute the PGBP income of SEZ unit for the current year. First we should compute the PGBP income of the SEZ unit for the current year. Then apply the formula based on turnover ratio. That is PGBP income of the SEZ unit into numerator export turnover of SEZ unit divided by total turnover of SEZ unit. Assassi may have some other unit outside SEZ, or maybe in free trade zone, or maybe in export oriented unit, and there also export is there. Do not consider only SEZ unit. All these formula is containing only the data of SEZ unit. And here the profit means not the book profit. PGBP income computed after making all disallowance, everything. PGBP income of SEZ unit into export turnover divided by total turnover. While computing PGBP income of SEZ unit for this formula purpose, remember, generally under section 28, profit on sale of import entitlement, profit on sale of import license, export import license, duty drawback, cash compensatory support, these type of export benefits must be taken as a PGBP income as per the provisions of section 28. But here, for the purpose of eligible profit, they are clearly mentioning, or there are numerous Supreme Court decisions, export profit means purely the profit earned from selling of goods outside India. This profit on sale of import entitlement, profit on sale of import license, or this cash compensatory support, duty drawback, refund of IGST or refund of ITC, all these things are incidental profit related to export. To promote export, government is giving some sort of incentives. That is not the real export profit. So if your PGBP income includes these items, it should be reduced. It should be reduced. So already while we are computing the PGBP income, usually all these items are to be included in PGBP as per 28. But after that, when we are applying this formula, just simply reduce that. Duty drawback, profit on sale of import license, other export benefits should be reduced. Turnover, again issue. They are saying turnover means the real turnover in connection with the export of goods or export of service. Sometimes to export the goods, we will incur some other expense like transit insurance, ship freight, demurrage, so the customs duty. So these type of incidental expenses will be incurred, and that will also be billed from the customer. From the customer outside India, we will bill value, price plus other expenses incidental to the export. So if it is a case of a service, the major expenditure to export the service is telecommunication charges. High speed internet is required to export the service. So telecommunication charge, transit insurance, freight, or any other expense incurred in connection with the delivery of this expense or services outside India. Sometimes the goods will be reached at the export port, and then from there will be a local transportation which will be arranged by the Indian client or Indian exporter, and that local transportation charge will be billed from the client along with the export of goods. So if that is included in the export turnover, that should be reduced. Turnover does not include these incidental expenses charged from the customer. That should be reduced from, not only from export turnover, it should be reduced from total turnover also. So exclusions from turnover, from both the turnover, export turnover as well as total, we have to reduce telecommunication charge, freight, transit insurance, delivery expense incurred outside India. So by applying this formula, we will get the eligible profit. Again, regarding export turnover, one more very important condition, that export turnover must be repatriated to India in convertible foreign exchange within the time prescribed in Foreign Exchange Management Act, FEMA Act, or sometimes the FEMA time period may be extended by RBI, then within such extended time permitted by RBI. Normally, the general time limit is 6 months from the end of the previous year. So, if the export turnover is 1 crore, but within 6 months from the end of the previous year only 70 lakhs is recovered, balance 30 lakhs is not recovered, then in the formula we have to put 70 lakhs only in numerator only. Numerator only this adjustment is applicable. Denominator, entire 1 crore will be there. Export turnover, we have to consider only the turnover which is received in convertible foreign exchange within the time prescribed under FEMA. Okay, these are the main provisions regarding 10AA SEZ. To claim 10AA deduction, assessee must file the return of income within the original due date, and in that original return you should claim also. So there are two conditions in chapter 6 heading C. Chapter 6 heading C, that is section 80 IA, IAB, IB, IC, even 80 QQB, 80 RRB, 80 JJAA, 80 M, 80 LA, 80 PA. All those deductions are contained in chapter 6 heading C. Chapter 6 heading C deductions and section 10AA deduction allowed to an assessee only if return is filed within original due date, and in that original due date return it should be claimed also. So if you claimed 1 rupee, then you can revise it and you can make that 1 into 100 rupees. But you should claim at least 1 rupee. Should be claimed in the original return filed within the original due date. Then only this deduction is allowed. So these are the main point regarding 10AA. So when we are doing the partnership firm question with this SEZ, there may be some issues. At which point of time, at what place we will claim this section 10AA deduction, and again, if there is a brought forward business loss, what we will do, at what point of time we will set off the brought forward business loss, at what point of time we will set off the brought forward unabsorbed depreciation, and at which place we will claim the remuneration. All those things is a very confusing one. So first step for firm and LLP, find out the net profit or net loss as per the P&L, make all the disallowance from 30 to 37, then add back remuneration debited to P&L, reduce all the expenses possible, reduce unabsorbed depreciation also, reduce unabsorbed also, so that you will get BP, book profit. Once you got the book profit, reduce remuneration under section 40B compared to the ceiling limit. Now you got current year business income. This current year PGBP income of SEZ, if it is an SEZ unit only, this should be the profit which is considered for the purpose of the formula. So this current year business income, from that we have to reduce duty drawback, profit on sale of import license, so that we will get the correct profit of SEZ unit for the purpose of applying the formula. Then apply export turnover divided by total turnover, you will get the eligible profit. Once you got the eligible profit, find out financial year 24-25, whether it is in the first 5 year of operation or next 5 year or next 5 year. Based on that, 100% or 50% of this eligible profit deduction just compute. But we are claiming it after chapter 6A because clearly saying 10AA deduction is not allowed inside BGBP. 10AA deduction is allowed after chapter 6A. It will be allowed from total income only. Total income means GTA minus chapter 6A. So from that total income, we have to reduce 10AA. So we can say that after chapter 6A, claim 10AA. So this is a 10AA deduction. Now we reached at the point current year business income. From that, reduce brought forward business losses. At this point of time, if you have other heads, consider capital gain, IFOS, or house property. Consider at this point after setting of brought forward business loss so that you will get GTA. Once you got the GTA, reduce chapter 6A, ATG or IA, IB, IC, ID, JAA, reduce all the chapter 6A and then reduce 10AA. So 10AA, this is a figure, but that figure we will claim after claiming chapter 6A. So sometimes what will happen? Eligible amount calculated as per the formula and 100% or 50% of the eligible profit may be rupees 50 lakhs. But after claiming all the chapter 6A, the income is only 20 lakhs. From 20 lakhs, you cannot claim 50 lakhs. So 10AA will be restricted to 20 lakhs. That is why they put this condition. This is the total income as per the regular provision. On this regular provision, we are computing the normal tax. Then we are going back and computing the AMT, whichever is higher is a tax liability. So this order you should keep in mind. So we can now we can try a problem, an application of all these things. If you want to, this one you can take a image, mobile photo or something like that, because it will be useful. There are complicated question they are asking, it will be useful. Otherwise, definitely you will make a mistake. Because if any one order is wrong, complete answer will be wrong. So we are going to solve that question number 25. 25. PRK LLP, a LLP set up a unit in a SEZ. LLP set up in a unit in a SEZ on 1st April 2019. So 1920 is the first year. 1920, 20, 21, 21, 22, 22, 23, 23, 24, 24, 25. So this is the 6th year of operation. Eligible profit into 50% is the deduction because this is 6th year of operation. And profit of the unit as per statement of P&L 65 lakhs after debiting or crediting the following item. Profit on sale of import entitlement 9 lakh, remuneration to its working partners 58 lakhs, interest at the rate of 16% per annum on partners capital of 20 lakhs, donation to a political party 3 lakhs, depreciation 17 lakhs. Here, profit on sale of import entitlement, it is an income taxable under PGBP. Now, no adjustment is required. But when you are considering that formula, profit of SEZ, you would reduce this. Now, nothing has to be done. Remuneration to working partners, add back. Interest excess 4%, add back. Donation to political party, not a business expense, add back. It is allowed as a chapter 6 reduction under 80 GGC. Now, we have to add back 3 lakh. Donation to political party. Depreciation add back because it's books of accounts depreciation, not 32. Additional information. Payment of remuneration to working partners and interest on capital authorized by the deed. Okay. Brought forward business loss from assessment year 2021, 4 lakhs. For computing book profit, brought forward business loss cannot set off. But we can set off unabsorbed depreciation. Next one is unabsorbed depreciation. Unabsorbed depreciation brought forward from assessment year 2021 was rupees 35 lakhs. But we have to make a check whether the entire unabsorbed depreciation is possible to set off. If it is possible, reduce 35 lakhs for the purpose of finding out the BP. Then SEZ details, total export, that we'll keep it there because first we need to find out the BP, so that should be there. Okay, turnover is there. Okay, fine. Depreciation of income tax 26 lakhs reduce. So if you do all this, you will get the book profit. Okay. What is interest in excess of 12%? How much? 80,000. See, there may be a confusion, right? Interest at the rate of 16% per annum on partner's capital of rupees 20 lakhs. So whether that 20 lakhs is capital or whether 20 lakhs is 16% interest. It's capital, right? Sure? No doubt. 100% sure. Because capital of rupees 20 lakhs. If you read completely, interest at the rate of 16% per annum on partner's capital of rupees 20 lakhs. It is confusing. This 80,000, how you calculated? 20 lakhs divided by, so no, 20 lakhs into 4%. Got it. Donation to political party 3 lakhs. Depreciation 17 lakhs. Less IT depreciation 26 lakhs. I didn't adjust the unabsorbed depreciation. Up to this point, what is income? $65 plus 58 plus 0.8 plus 3 plus 17 minus 26. 5. 117.8 lakhs. Less brought forward. See, anyway, if we keep the order, first we are setting off a brought forward business loss of 4 lakhs, then unabsorbed depreciation, entire unabsorbed depreciation is possible. So no problem, we can set off unabsorbed depreciation for the purpose of book profit. That is unabsorbed depreciation 35 lakhs. We got book profit. What is the book profit? 82.8 lakhs. Once we got the book profit of 82.8, now we have to compute the ceiling limit for the purpose of claiming remuneration. Plus remuneration. So remuneration 82.8, we have to calculate the slab rate, and partners actual remuneration is 58 lakhs. So what is the ceiling limit? .48 ceiling limit actually is 58, so only less 51.48. So we got current year PGBP income before setting off the brought forward business losses. So what is that? 31.32 lakhs. So remember, first we have to find out the book profit. For the purpose of finding out book profit, we have to reduce the unabsorbed depreciation that we reduced. We got book profit. We claimed remuneration. Balance is the current year business income before making setting off of losses. This current year business income should be taken for the 10AA purpose after reducing that incidental profits. So current year 31.32. minus, I'm doing the 10AA calculation. We can continue the problem now. 10AA is reducing only loss, but just I'm doing this. Current year PGP 31.32 minus, we have to reduce profit on import license 9. That this one we have to reduce. And yeah, that's item to be reduced from the profit. Then only we will apply the export turnover and total turnover. We will get the eligible profit. Into that, 50% will be the deduction under section 10AA. Okay, that we will do later. So once we got the current year PGP income, the next step is set off of brought forward losses. So what is the brought forward losses here? 4 lakhs. So what is the balance amount? 27.32. Whether there is any other head of income? Whether there is any other head of income? In this question, there is no other head of income. So we got the GTI. Once we reduce brought forward business loss, we got the GTI. There is no other, there is only chapter 6A, that is donation to political party. So it is assumed that the donation to political party is made by check. If you take that assumption, we can reduce. If you are not taking that assumption, we cannot reduce. So donation to political party, I am taking the view, it is by check. Okay, then we can claim that. So 27.32 is the GTI. Less 80 GGC, 3 lakhs. Is the balance available? 24.32. From this 24.32, we are going to claim section 10AA. Now we have to apply the formula. Total export turnover 45 crore and the sale proceeds in convertible foreign exchange received in India by 30th September 2025 was 38 crore. Total export turnover of 45 crore included telecommunication charges of 5 crore attributed to delivery of software. Sale proceeds realization of 38 crore also include telecommunication charges of 2 crore. So realized amount is 38 crore, out of which telecommunication charge 2 crore I reduced. And what is the total turnover we have to take? Total export turnover is 45 crore plus whether there is any domestic turnover? Whether there is any domestic turnover is given? Where say? No. That is part of profit. No. I'm saying whether they are giving separately any domestic turnover data. No. So total export turnover is 45 crore. That is the total turnover. So 45 minus. Out of this 45, what is the telecommunication charges? Out of 45, what is the telecommunication charge? 5. So 40. Denominator 40. Numerator 36. 36 by 40. We will get the export profit. What is export profit? 31.32 minus 9. That is the PGBP income of SEZ unit for the purpose of applying this particular formula. 31.32 minus 9 into 36 divided by 40. That's eligible profit. There is no domestic turnover. So what is the export profit? Eligible profit. 20.088 into 50% because it's 6th year of operation. 50% is reduction allowed. 20.088 into 50%, how much? 10.044. Yeah. A claim 10AA. Total income as per the regular provisions of the income tax law. $14.276 lakhs, right? Total income as per the regular provisions of the income tax law 14.276. The question is asking regarding the tax payable by PRK LLP. So we have to go to the AMT provision. So on this, we can simply calculate the tax 14.276. It is an LLP. Rate of tax will be, there is no capital gain, there is no flat rate taxing income, all income is normal income. So 14.276 into 30% tax, you have to compute that. 30% tax, 4% cess. Tax as per regular provision. 14.276 into 30% plus 4% cess. 4.45 4.4541. Okay. This is a normal tax. So now we have to go to section 115 JC, JD, JW, JF. Main section JC. As per section 115 JC, if an assessee is not a company, individual HUF, AOP, BOI, partnership firm, LLP, not a company, whether resident or non-resident, claiming any of the deductions under chapter 6A heading C or 35 AD or 10 AA, they are liable for AMT. We have to check the tax liability by considering AMT. So if they are claiming any one of these deductions, their tax liability shall be tax computed as per the regular provisions of the income tax law or AMT computed as per the provisions of 115 JC, whichever is higher. So how the AMT will be computed? Starting point of AMT calculation is total income computed as per the regular provisions of the income tax law. In this case, total income computed as per the regular provisions of the income tax law is 14.276. That 14.276 is the starting point. On this total income computed as per the regular provisions of the income tax law, add number 1, 10 AA deduction claim defining, add. Number 2, chapter 6A heading C deductions. That is 80 IAB, IB, IC or QQB, RRB, JJAA. Only those deductions, add. And third, if you claimed 35 AD deduction, do not add back 35 AD deduction amount directly. What is the 35 AD deduction claimed amount? That is capital expenditure of that specified business. Inner column, reduce notional depreciation. Instead of claiming section 35 AD reduction, if you would have been claimed section 32, what would have been the amount of depreciation? That should be reduced from the cost of that 35 AD assets. So we'll get the remaining amount that should be added. So the provisions of this AMT, 2 items we have to add back directly, but third item do not make direct add back, but you have to reduce the notional depreciation. So total income as per the regular provisions of the income tax law, add 10 AA deduction claim, add heading C. For example, QQB, RRB, JJAA, IAB, IAC, IB, IA. And then 35 AD deduction claimed inner column plus notional depreciation under section 32. Usually that will be only for 1 year because current year we claimed 35 AD, only current year depreciation. So balance should be added so that you will get adjusted total income. Regarding individual and HUF, we have to proceed with the AMD only if this adjusted total income is more than 20 lakhs. But if it is partnership firm or LLP, anyway we have to proceed on this adjusted total income. AMT will be 18.5%. And if adjusted total income crosses 1 crore, we have to take surcharge on this AMT. In respect of individual and HUF, if total income, adjusted total income crosses 50 lakhs, we have to take surcharge. In case of firm and LLP, if the adjusted total income exceeds 1 crore, we have to take surcharge. And then add 4% health and education cess, we will get the AMT. So now we will have two tax. One is tax computed as per the provisions of the normal provisions of the income tax law, and another one is AMT. Whichever is higher is the tax liability. If AMT is higher, AMT is a liability and adjusted total income is deemed to be your total income. And if AMT is high, normal tax is low, the difference to the extent of AMD exceeds normal tax, that can be claimed as AMD credit, and it can be carry forward for maximum 15 assessment years. And in subsequent year, when normal tax is more than the AMD, this credit can be utilized. But utilization is restricted to the extent next year normal income tax exceeds AMD, only to that range you can adjust AMD credit. Remaining again carry forward maximum 15 assessment years. AMD credit will never be allowed as a refund. It should be utilized. Otherwise, it shall lapse. AMD credit cannot be carried forward to any other assessee under restructuring. Assessee can carry forward maximum 15 assessment years. So this is the point of AMD. So now in our problem, only 10AA is there. There is no QQB, RRB, JJAA, IAB, IB, IC, etc. There is no 35AD. So just add back 10AA deduction to the total income. We will get the adjusted total income and find out AMD. So total income as per the regular provision is 14.276. Add 10AA. Yeah, 10.044, right? We got ATI. $24.3. Chapter 6A heading C. Chapter 6A have heading A, heading B, heading C, heading CA, heading D. Heading A, basic conditions of chapter 6A. Heading B, ATC to GGC. Heading C, after heading B, heading C, QQB, RRB. This. So if you take from the start, ATH, HH, HHB, all those sections not relevant. IA, IAB, IB, IC, ID, QQB, RRB, JJAA, ATLA, ATM, PPA. Only that. Okay. C, CC, D, DD, heading B. TTA, TDB, heading D. Heading CA, actually there is heading CA. ATU, heading D. So chapter 6 have various headings. They are saying only heading C. Another specialty of heading C, you can claim only if you file the return in due date. And in that return, you should claim also. Got it. So no need to add 80 GGC. That is not a deduction coming under heading C. So 24.32, 18.5. No surcharge, 4% cess. Get AMD. What is AMD? 4.6791. So normal tax is 4.4541 and AMD 4.6791. So AMD is higher, AMD is payable. Once AMD is payable, take the difference between AMD and normal tax, that is AMD credit. So what is AMD credit? 0.225. It is actually a previous question. They asked in examination. Majority of the students made the mistakes because definitely they will confuse with that order. At what point of time we should adjust unabsorbed, brought forward loss, book profit, 10AA. Okay. So this is AMD. Once AMD credit arises, in subsequent year, even though there is no AMD, because AMD applicable only when assessee is claiming 10AA or 35AD or heading C, otherwise there will be no AMD. So in subsequent year, even though there is no AMD, no problem. You can utilize this credit up to 15 years. So what is the idea? The tax incentives under the income tax law is actually a big lie. It is a comedy. There is no incentive. If you enjoy incentive, you have to pay AMD. So go to some rural area, purchase some agriculture land, do some agriculture. Don't do any other activity. 10(1) exempt, no tax. Otherwise, you have to pay tax. So the concept of incentive is highly diluted. There is no pure incentive. They are saying big lies. Yeah, people are like that. They will sell that lies, and people will buy it. Not commenting on that. Okay. So this is AMD. So AMD is over. So over means just you got an idea. So today we will wind up. So tomorrow we will do the assessment of companies. Companies is very, very important. Remember normal computation, math computation. If a company is following IND-AS based math computation, 115 BAA, 115 BAB. So all these things are there. Assessment of company, that's very important. So morning session we will do the assessment of companies, all those provisions we will discuss. Then we will go to charitable trust and real estate investment trust and alternate investment fund and all those topics. Okay, so